Yes, yes, sir.
I
Yes, sir.
enabled recording.
Yeah,
Okay.
yes, sir. Sure, sir. Yeah, good afternoon, friends. We will continue our CRM policy. Next one is legal audit of title deeds. So this legal audit of title deeds, recently even in monitoring tools also it has come. It is applicable for exposures of 5 crores and above, 1 point here, and after 3 years. That means at the time of sanctioning or at the time of crossing this threshold limit, first time we will do this legal audit of title deeds, and thereafter every 3 years we will do this legal audit, but it is coinciding with RBIA, our internal inspection. It has to coincide. So once in 3 years, I told you, as per this scheme, suppose branch inspection is once in 18 months. In such case, 3 inspections it has to cross. So 18 into 3, 54 months it will come. That is why the gap between 2 legal audits will be between 36 months and 54 months because of 18 months RBIA periodicity issue, right? So here 3 points, 5 crores and above, once in 3 years, and 36 to 54 months. And this legal audit should be done by another advocate, not the same advocate who has given LSR. But regarding opening of current accounts, of
Sir,
course.
small.
Yeah.
Sir, excuse me, sir.
Please.
You check up your battery level, sir. If you want, you can put in charge.
Yeah, it is 100%, sir. That's why I have kept.
Okay. Okay, sir.
Yes. Yes. Yeah. Any, sir, very dim is there? Okay, I will continue. Next is regarding opening of current accounts. Yeah. Opening of current accounts. 2 issues here. First one is where borrower is enjoying exposure up to 5 crores from the banking system. First one. Here without ODCC. And second one is there with ODCC. Suppose he is there, somebody having ODCC account. In that case, how to open current account. So first issue we will see. The branch normally, wherever party is enjoying limits with other banks, we are not supposed to open current accounts. Even our bank guidelines also given, preferably you have to verify credit reports. If party is enjoying limits with other banks, don't open. Okay, here, suppose aggregate, if he is enjoying less than 5 crores, we may open, but that is financing banks, not again other banks. Financing banks, they may open current account, but party has to inform the branch whenever the threshold limit of 5 crores or more crosses. Because once if it is crossing 5 crores means other guideline will come. What is that guideline? Party has to open current account where party is having at least 10% of the share in the total limits. Number one, or in with which major bank out of all lenders which is having higher exposure. In consortium we call it as a leader, but in this case MBMA, it is not leader, bank which is having highest exposure, actually the highest share. Generally they have to open with that bank only where it is having highest share. This is second one. And third one, above 50 crores, what they say is normally escrow mechanism they have to follow in case of this consortium accounts. Otherwise, with the leader or higher exposure, they have to open current account. Other branches, other banks, that means other than those who are having higher exposure or leader, they may open collection accounts with a condition that periodically whatever amount is credited into this account, it will be transferred to ODCC immediately. Otherwise, party will be losing interest. That is one. And second one, even individual banks, they may adjust this towards their loan account instead of sharing commonly by all banks. That means any amount comes there, it is to be shared by all banks towards the repayment. If one bank is account maintaining account and amount is credited into that bank may take total amount. So to avoid this, guidelines are given, it is to be credited to escrow account periodically or OCC account, right? Next, regarding cash credit also, same guidelines will come. ODCC, provide a customer who is enjoying less than 5 crores, yes, we can allow. And it is more than 5 crores, again 10% or more exposure. Again, wherever it is above crossing 50 crores, then escrow mechanism, same guideline, just like earlier one only. Now, we go for external credit rating. So here there was a question, I think last 2-3 years back, for 1 to 2 they asked, they have given external credit agencies, domestic rating agencies they have given, and one international rating agency has given. You identify which is odd man out. So that international rating agency, they have to identify like that. That is why I have given even names also, all whatever the domestic rating agencies are there at present, where we are availing services, that also is given. So ECII rating, external rating is applicable for about 25 crores only. Up to 25 crores, we are doing our internal rating models are there that applicable. About 25 crores, party has to go for external rating. And if any party is enjoying about 25 crores, and if he is not taking external rating, means we charge additional rate of interest. That is also there, basing on again quantum, that additional interest is there. And waiver of external agency, it is ED, CAC and above authority, not below that. That is why parties enjoying 25 about 25 crores, compulsorily they should take external credit assessment rating. So domestic ratings are there, CARE, CRISIL, ICRA, that is Fitch, ICRA and India ratings, Fitch, Acute and Brickworks, Infomerix. These are Indian rating agencies, 7, plus international rating agencies are there. I think this we have to disable. Is there? 1 minute, sir. I think some. We have to disable lines here. It has come. I think it has changed. Madam Tiwari ji has left. ओक्का निमिषम सर तिवारी जी, ये लाइन्स इसको ना डिसेबल करना सर, वो तो दूसरे ये है ना इसमें, हाँ वो तो दूसरा वाला किया तो ये आ रहे ना, आई थिंक अदरवाइज ना ये सब इसको डिसेबल करना, अदरवाइज ना ना यहाँ नहीं, इस सिस्टम में वेर यू हैव चेंज्ड द सिस्टम है ना, उसमें अर्लियर यू हैव डन, मॉर्निंग यू हैव डन एंड ఒక్క నిమిషం సార్ తో మాట్లాడేసి దట్ స్టాప్ చేపిస్తాను సార్. సార్ అది లైన్స్ డిజేబుల్ చేయాలి సార్, దానికోసం చూస్తున్నా. 1 minute. అదే యానిటేషన్స్ సార్, యానిటేషన్స్ डिजेबल कीजिए. यस అదే యానిటేషన్స్ उसमें डिजेबल है या बस ओके ना. बट ये लाइन तो नहीं गया. हाँ ये तो देखेंगे सर. नहीं इसको बंद कीजिए, ये है ना, ये अलग है, विल सी. ये अलग doesn't matter, we'll see afterwards, we'll see. ये तो ना एनोटेशन कर दे, हां टीएम के बाद देखेंगे सर. टीएम या yes sir. Regarding international agencies, 3 are there: Fitch ratings, Moody's, Standard and Poor, 3 ratings, and timelines for obtention of external ratings. Here suppose greenfield projects, that means starting from beginning onwards, starting from scratch, that is new projects, greenfield projects. Normally at the time of beginning they may not have rating, they should go subsequently for rating. That is why we will give 6 months time from the date of sanction for submission of this in case of greenfield projects. And the party already applied for external ratings, in such cases 3 months time we will give for submission of this ratings. In case externally unrated borrowers with exposures above 25 crores, as I told you, we have to charge additional rates. Here 25 crores to 100 crores, if party is enjoying limits, in such case additional interest of 0.25% we will charge over and above the applicable rate of interest. And for exposures above 100 crores, additional 0.5% we will charge for not rating by external agencies. And this additional interest is not applicable in case of central government and state government accounts. Yeah, some maybe. Yes, sir. Yeah. Okay. Next one, monitoring of cross default and other financial covenants. First, we will discuss what is cross default. Cross default means, suppose party is enjoying limits with 2-3 banks. If there is a default with one bank, it may trigger default with other bank also. Suppose now he is defaulted with other bank. Future, charging additional rate of interest is substitute for ECI rating. It is not substitute for ECI rating. Till he gets ECI rating, we have to charge penal interest so that party will go and approach external agencies and get a rating, sir. And waiver, it is not at all permitted. This is the question. No question of waiver other than EDCAC and above authorities. So additional charging means we are penalizing the party for not following our guidelines, because external rating is very important, not only for banks, even for public, suppliers, everything, all stakeholders, they should know. That is why external rating is compulsory. Till he gets external rating, we have to charge penal. At least to avoid penal rate of interest, the party may go and approach external ratings and get it done. Bas. Next, cross default. If party is defaulting with one bank, it may trigger default with other lender also. That is why cross default we have to take care. And when we call it a default, if there are overdues in the account in any of the bank, more than 30 days. That means if he is clearing within 30 days, absolutely no problem. We don't call it as a cross default. If he is not clearing within 30 days with the other bank, then in future, in our bank also, he may default. So this is what we call as cross default. To monitor this cross default, we have to monitor. CRILC reports are there. Wherever there are defaults of parties with 5 crores and above, weekly we will be getting reports. So we have to go through those reports and monitor. Apart from that, we have to monitor P&L covenants also. For this cross default, applicability is again corporates, listed corporates with exposure of 50 crores and above, and listed MSME borrowers with exposure of rupees 1 crore and above. This is what applicable for this cross default applicability. And how we will cross check apart from CRILC, we should call for P&L covenants. That is P&L covenants quarterly we will monitor. What are all the covenants in P&L we will monitor totally? Net sales, net profit ratio, interest coverage ratio, etc. For these eligible entities, we will monitor, and any variations we will take care. And balance sheet covenants. This is gearing ratio, that is TOL is to TNW, debt equity ratio and current ratio, etc. And balance sheet normally yearly basis party will be submitting. So yearly basis, we check any cross defaults also, it is there, right? So breach in financial covenants would deem to have occurred if there is a deterioration of more than 10%. You are monitoring these financials, either net sales or profit ratio or P&L covenants, wherever there is variation of more than 10%. In the actual level vis-a-vis sanction level. At the time of sanction, what was the ratio? Today, what is the ratio? So whether it is exceeding more than 10%, in such case, we have to exercise caution. This is what monitoring of financials. Okay, this is regarding consortium, how to calculate, because consortium is common documentation and all banks will have common interest, etc. In consortium, how to classify an asset? Suppose in one bank account is classified as MPA, whereas in other bank it is a performing asset. In such cases, basing on individuals bank's recovery, they may classify. Doesn't matter, in one bank it is slipped to NPA, other bank which is having all regular payments, it will continue in standard asset only. This is regarding provisioning and the classification of consortium, classification in case of consortium. Next, regarding consortium meetings also, there is a guideline. Consortium meetings, parties enjoying 25 crores and above, where important decision is to be taken in a consortium meeting, and where our bank is the leader. So 3 points here. One is our bank is a leader. Second one is limits 25 crores and above. And the third one is important decisions are to be taken. In such cases, GM of the circle has to attend the meeting, supported by along with the branch head or second. Branch head is not available, next person. So above 25 crores first criteria. Second one, we are leader. And third one is where important decision is to be taken. In such cases, GM has to come. And if it is less than 25 crores, DGM will come for meeting. The remaining same, that is less than 25 crores, we are leader, where important decision is to be taken. In such case, DGM will attend the meeting. 2 cases. Next, suppose we are not leader and it is a routine meeting. In such cases, attendance by branch in charge if it is headed by scale 4 or 5. And branch is headed by non-executive, then one executive from circle along with branch in charge. So normally what general guideline is that consortium meetings are to be attended by at least executives. Supported if branch head is not executive, he will accompany. He has to accompany in all meetings. Right? Next one. Suppose if we are a leader in consortium, if we are the leader, in such case, within 3 days of meeting, we have to prepare minutes and circulate to the all members. Minutes of the consortium meeting, we have to circulate it to the all members. Right? Next one. Certificates or reports issued by third-party entities or professionals and submitted by borrowers need for independent due diligence. Chartered accountants, engineers, etc., they are submitting us reports like your financial statement or valuations, etc. So these are all third-party entities. Wherever they have submitted, we have to correspond with them directly and communicate regarding this, whether you have submitted report, is it okay? We have to discuss and confirm with direct communication. That is one. And second one, verification, where we have to verify UDIN portal. So all these chartered accountants, etc., they will have that number, identification number, and they will load the whatever this balance sheets, etc., audited balance sheets they will give. They will load in the UDIN portal, and we have to verify in this UDIN portal all certificates issued by chartered accountants. Next, off balance sheet exposure. Only few points we will go through fast in this. One is performance guarantee. Second one is financial guarantees. Generally, all financial guarantees only, but for practical purpose, we call performance guarantee, where we are giving to contractors for completion of their work. We call it as a performance guarantee. Or if you are assuring any financials, we call it as a financial guarantee. Like repayment, somebody is importing machinery or somebody is purchasing machinery on deferred payment basis. There we are giving guarantee. So that is financial guarantee. That means we are guaranteeing finance. Even in performance also we will guarantee, but finance only. But since we are guaranteeing the work to be done by person, we call it as performance guarantee. Though we are giving funds, in case of failure by our borrower, we will pay amount only and we will not complete the work. So they are performance guarantees, and we are, if you are giving guarantee on behalf of financials, then it is financial guarantee. So another condition, BGs of 5 crores and above, quarterly status report to be submitted by borrower for PAG, PG or APG. Quarterly report, progress report, they will submit for performance guarantees and advance payment guarantees. Next, normally third party deposit, we should not consider it as a margin, but we can consider it for collateral security. Because normally minimum margin 25% we are prescribing. Minimum margin he has to bring party from his own packet. And for remaining security, that is collateral, we may accept this third party deposit. Right? Minimum margin requirement for bank guarantees issued beyond 5 years. It shall be 25% in the form of TDR. Okay. Next one. Now another condition, guarantees favoring other banks. Earlier we have seen lending against guarantees issued by other banks. Now it is guarantees favoring other banks or financial institutions or other lending agencies, where we will give these guarantees. So if he is a good customer, again our exposure to that particular sector is more. In such cases we will give guarantee. Or if some other any financial institution is lending at reasonable terms and conditions, we may give, because we don't want to lose our big customer. So whatever may be the reason, here the conditions are borrower is well established and having satisfactory dealings with us for at least 3 years. That is first condition. And bank should have fund-based exposure to the party to the extent of at least 10% of the amount and 5% in case of infrastructure projects. That's what. If party is asking for 100 crores bank guarantee, at least he should enjoy 10 crores fund-based limits with us. In case of infrastructure projects, at least 5 crores he has to enjoy limits with us, fund-based. In such cases only, we will issue. So the quantum of guarantee as bank as a whole is restricted to 10% of our tier 1 capital. This is prudential exposure norm again. And minimum amount of each guarantee is 1 crore. and the nature of guarantee is financial. This is regarding guarantees. LCs, of course, will be dealt in Forex in detail. Here only 2-3 points in LC we will remember. Here, if party is not required to tender documents, LC में क्या है? We are suppose we are issuing LC on behalf of our customer and in favor of some foreign suppliers. That foreign supplier will supply goods to our customer and send us documents directly, and we will hand over our party and collect amount and send him. This is what mechanism simply. But here, the foreign party, he need not submit documents for payment. Normally, he submits documents, we will collect from the party and make payment. Otherwise, we will debit loan account and pay directly. But if he doesn't need to submit any documents, we call it as clean letter of credit, because it is not accompanied by documentary evidence of title to goods, documentary title to goods, like your bill of lading or airway bill, etc. It is not accompanied. So we call it as clean letter of credit. That is one. Next, branches should not open without recourse, etc. It should be signed. Normally, LCs are to be signed with joint signatures. Out of 2 authorized signatures, at least one should be manager or senior manager. Next, TOL is TNW, that is gearing ratio, maximum 4:1 in case of working capital finance, and relaxations also permitted. Okay. Quarterly report on LCs, etc., etc. Here, no, for monitoring purpose, 5 lakhs and above LC and guarantees, we will take call for quarterly reports, how much work they have done, etc. Standby LC, several times this question has come. What is standby LC? It is similar to financial guarantee, standby LC. So here no movement of goods, etc., whatever it is. Simply we will say, we will give time within 1 year. If party is not meeting his commitments, yes, we will pay. So that's certain amount. So instead of guarantee for foreign transactions, we give standby LCs. Here period is maximum 1 year. Next, grant of non-fund based facilities to non-customers. Here only prudential exposure norm is total exposure to non-constituent borrower shall not exceed 3% of the bank's capital funds. Only single point here, prudential norm. Next one, we go for second part of the policy. Here comes your broad guidelines. IRB guidelines, internal ratings based guidelines. Next, policy framework. Okay, board of here framework may our credit risk management policy, apex body is board of directors and supported by risk management committee of the board. They will review it annually. Inspection wing will conduct independent assessments annually. Thus, this is the structure briefly for this purpose. Now, credit risk. Olden days they used to ask this definition of this credit risk. Okay. Possibility of losses associated with default by counterparties. That means the counterparty, as is borrower, is agreeing to pay the amount periodically or lump sum, whatever it is. If he is failing, we call it as a credit risk. That is what possibility of losses due to failure of counterparty to meet obligations. Next, in case of retail loans, to consider as a default. Earlier, we have seen what is default in cross default. May within 30 days, if they are not rectifying, we call it as a default. But in general terminology, even single day default also, we call it as a default. That is why in our critical reports, every week it is coming in a 1 day default, 2 day default, that also it is reflecting, right? In case of retail loans, exclusively retail loans are overdue. How to calculate this default? If total interest and our principal exceeds 50% of the total retail exposure, then only to that particular entire other limits of the borrower also will be considered as default, right? Next, regarding expected loss, unexpected loss, probability of default, loss given default, only equation they have given earlier. We will not much discuss already, since I have discussed in the morning is expected losses are covered by pricing and provisioning. Unexpected losses are covered by capital as a cushion. Next, how to calculate this expected losses? EL is equal to probability of default into loss given default into exposure at default. This is the equation. Basing on this, we will calculate this expected losses. And for this expected losses, we will add your pricing or we will increase provisioning. Bas. Next, risk management committee of the board. It is headed by chairman of the bank, consists of MD and CEO, EDs, and 3 other directors of the bank, and they oversee risk management. This is apex body, I told you. And after that, credit risk management committee is there. This is the important committee who will take some important decisions. What are the we see? MD and CEO, EDs, RMing heads of all credit things like all other credit, priority credit plus your MSME, etc. All credit things, they will come. CAM, RBS, and inspection wing. Special invitees are GM of RMing and wing head of note placing wing. Okay, they monitor implementation of CRM policy, ensure compliance with prudential limits, and decide delegation of powers, collaterals, pricing of loans, and provisioning. So here the question is, who decides the delegation of powers in the bank? If they ask like that, it is Credit Risk Management Committee plus. And CGM of risk management thing is Chief Risk Officer. Borrowers termed moderate risk, BBB, I told you, moderate risk and better, they are termed as investment grade. And we will finance them. Below BBB, normally, high risk it will come. Normally, we should not encourage. Only at CSC, already we have discussed this. And no authority other than CSC of board and above authorities empowered to permit credit facilities to highly risk-rated people. Next one. Regarding expected losses, of course, in Basel also this point will come. Regarding expected losses, if the expected losses amount, whatever we are calculating, we are keeping provision. So all these eligible provisions, if they are over and above the expected losses, that means provisions are more and expected losses are less. In such a case, the differential amount of provisions, it can be included under Tier 2 capital up to maximum 0.6% of credit risk weighted assets. This is in case of IRB approach mein aayega, not in standardized method. Standardized mein 1.25 is given. Anyway, I will discuss in Basel, right? Next, RAROC, risk adjusted return on capital. Here, all MSME borrowers having exposure of 1 crore and above, and corporate borrowers having exposure of 24 and 5 crores and above, it is applicable. Anyway, it will come through SAS package, risk adjusted return. Only applicability for exam point of view, it is applicable for MSME 1 crore and above, corporates 25 crores and above. Next, regarding procedure documents, policy and strategies, to avoid concentration risk, bank has come out with large exposure restrictions and large exposures, etc. We will see what is that large exposure or big borrowers. Definition of large exposure is any party who specified borrower, it has come. Now I am not using much, but any borrower who is enjoying 10 crore and above from banking system, they are called as specified borrowers. Now regarding large exposure, to avoid concentration risk, these large exposure norms are given. These large exposure, whom we call as a large exposure, any party, if they are enjoying credit limits equal to or above 10% of our bank's eligible capital. Eligible capital means Tier 1 capital. Suppose, for example, if our Tier 1 capital is 1 lakh crores. So 1 lakh crores may 10% is 10,000 crores. If we are giving loan to a borrower with exposure of 10,000 crores or above, we call them as large exposures. Large exposures, right? This is what Tier 1 capital may 10% and above. If anybody we are financing, then we call them as large exposure. Now limits to such large exposure borrowers. Example only I told you 10,000 crores to understand purpose, but it is 10% of our capital, right? Now, what are the limits? Single party. For single party, how much we can sanction loan to borrower? 20% of bank's available eligible capital. In large exposure may to any counterparty, that is to any borrower, we should not give loan of more than 20% of our Tier 1 capital. For example, earlier example, 1 lakh crores I told you approximately our Tier 1 capital. So 20,000 crores is 20%. We should not give loan exceeding 20 25,000 crores to any single borrower. This is what large exposure, so to a single party. Suppose if it is a group of connected counterparties, say Reliance Group, so many are there in that subsector, all put together we call as Reliance Group. In such cases, 25% of banks tier 1 capital base. If you take an earlier example, here 25,000 crores to entire group, it should not exceed. So in earlier one, 20% single corporate 20% and another 5% it may exceed with the board's permission. In exceptional cases, with board's permission, to single borrower also, we may go up to 25%. That means in earlier example, up to 25,000 crores, we can give to single borrower also, as well as group also, it should not exceed 25,000 crores as per our example, right? Next one. Interbank exposures, except intraday interbank exposures, they are also interbank, say our bank to some other bank, Canara Bank to State Bank of India. That is what interbank exposures. Consortium party can take the same from multiple banks. Yeah, there is one query small regarding consortium. Consortium is separate and multiple banking MBA is separate. I will clarify again. Consortium is separate, MBA is separate. Consortium is common documentation, MBA separate documentation. Terms and conditions are separate, but classification may same individual bank wise. Similar to MBA also, classification also individual bank wise. If there is recovery under MBA in one bank, they will classify as standard assets. If there is no recovery, they classify as NPA. Bus. Right. Next, regarding interbank exposures. Interbank expose one bank to another bank up to 25% of our bank's. Suppose if we want to give loan to Union Bank of India or some other bank, up to 25% of our tier 1 capital we can give. This is what interbank exposures. Not only direct finance, all guarantees, etc. It will come here. Next, definition of connected counterparties. So here two definitions. One is group of connected counterparties. Second one, definition of connected. Earlier we used to call commonality or management and effective control over management. This is for group. This several times even in exam also it has appeared. Commonality of management and effective control on the management. But now interbank connected connected counterparties means specific relationships or dependencies such that one of the counterparties to fail, all other counterparties also likely to fail. Earlier we have seen in a cross default, just like that, but not same. So there is in relationship between both parties that in case of failure of one party, other party also may fail. This is what definition of connected parties. Otherwise, second one also. Yes, here to one counterparty, 10%, 10% and 20%, this definition may some confusion has come. I will clarify here. To call any person as a large exposure person, to call any person as a large exposure person, if they are enjoying 10% of equal to or exceeding 10% of our tier 1 capital. Example may, if anybody is enjoying 10,000 crores and above, since our tier 1 capital is 1 lakh crores, example we have taken. We call them as a large borrowers. But to whom, maximum amount, how much we can give? 10% it is available means we are calling them as large. They can avail up to 20% means up to 20,000 crores they can avail. First one is definition, second one is entitlement. That is only difference here, right? Okay, in case of loan given in MBA or JLG becomes NPA in one bank, what will happen to other banks? It is only cross default. Say suppose account are standard, yes, other banks are standard. It is a cross default. We can't do anything. Wherever recovery is there, that bank will keep it in a standard asset only. But Reserve Bank has given guideline regarding maintenance of that account, escrow account. If any bank is maintaining escrow account, and if it is not sharing proportionate recoveries to other member banks, in such cases, Reserve Bank has told punishment to the bank which has not shared proportionate amount, they have to keep higher provision. That is the punishment for bank which has not shared in proportionate recovery. Except that क्लासिफिकेशन अपना अपना मर्जी, any बैंक में recovery regular है, yes, they will as it is classify as standard. Recovery is not the NPA. But lead bank or other bank which is maintaining account, escrow account, if they are not sharing proportionately, unko punishment hai, they have to keep higher provision on this loan. That is the guideline, right? Next one we go. Yes. Next, interbank exposure we have discussed it is 25%. Connected counterparties also, if one fails, other also likely to fail, then we call it as a connected counterparty. Group of connected counterparty means control relationship or economic interdependence. So suppose one unit is completely supplying material to other unit only. So iska whatever material is produced by one unit, it is absorbed by other sister concerned unit only. They cannot sell to others. In such case, we call it as connected counterparties. Like that, any relationship, that is what economic interdependence. And control relationship, both owners are same, both directors are common, like that. Okay. But mostly for exam, this they are asking commonality of management and effective control of management is called as group concept. So 20%, 25% exposure norms, that is what prudential exposure norms guidelines regarding large exposures. Now to exposure to NBFCs, non-banking finance companies. NBFCs exposures similar to other corporates only. That is single NBFC has 20% of our tier 1 capital. Group of NBFCs go 25% of our tier 1 capital will give. But in case of gold loan companies, NBFCs, where their gold loan exposure is 50% or more financial assets, 50% or more in the form of gold loans. And for such gold loan companies, our finance is restricted to 7.5% of our tier 1 capital. In our previous example, for such type of gold loan NBFC companies, we can finance up to maximum 7,500 crores only, as example only, right? But 7.5%, please remember. Right. Large exposure rules for globally systematically important bank, GSIBs. GSIB is nothing but too big to fail. That is what definition of GSIB, too big to fail. And in India, 3 GSIBs are domestic DSIBs are there. State Bank, ICICI and HDFC, they have identified. Still this year also they are continuing. These globally systematic investment banks, GSIBs. GSIBs to another GSIB is 15% only exposure. This is regarding exposure. Earlier gold loans we have seen 7.5%, and here between banks earlier I told you just like other corporate, but here GSIB to GSIB it is 15%. GSIB to non-GSIB or non-GSIB to GSIB it is 20% exposure. That means 20% of our tier 1 capital. Right. Next one, substantial exposure. Here, substantial exposure, only high level people may remember, others it may not touch. Substantial exposure means wherever we are financing large borrowers of 10% and above, as I told you earlier example, may 1 lakh crores, our example, if you take capital, 10,000 crores and above, if you have given loans to some people, all loans of such people put together, wherever 10% of our capital funds is exceeded, all loans put together. That means somewhere you have given 10,000 crores as per our example, kisi ko 20,000 diya, kisi ko 15,000 diya. All such loans put together should not exceed 600% or 800%, means 6 times or 8 times of our capital. Suppose our capital both put together, you take say 150 crores. 150 crores may 600%, 6 times means 150 may 6 times 600, it will be 9 lakh, almost a very heavy amount. Normally, it will not go that much, right? For understanding purpose, I tell you, wherever 10% exceeding our capital funds loans are given, for example, 10,000 above, all such loans put together should not exceed 6 times or 8 times of our capital. Bus. This is about substantial exposure. Next. This is important for exam where they are touching credit exposure maximum ceiling for individual as well as non-corporate borrowers. These policies are our bank has developed basing on broad guidelines from Reserve Bank of India. Broad guidelines are as per RBI. Within broad guidelines, internally we have developed other guidelines. Majority are RBI guidelines as it is. Only few guidelines as per our internal policies we have modified. But within, we should not exceed our limits, exceeding broad guidelines of Reserve Bank of India. Within broad guidelines of RBI, we have framed our own guidelines. This is regarding query, right? Next one. Credit exposure ceiling for individual and non-corporate. To individual borrowers, maximum we can lend to 30 crores only. Any individual borrower, single borrower, maximum we can lend up to 30 crores only for other than for business purpose. If it is a proprietorship concern, maximum 75 crores. Maximum 75 crores only we can sanction to proprietor concern. And single entity with the constitution as association or HUF, for maximum quantum is 75 crores we can sanction. HUF or association. Next comes single entity with the constitution as society and trust for educational institutions and hospitals. Here you have to keep in mind, it is a society or trust, but it is running hospital or educational institution. In such cases, we will sanction higher limits, that is low risk high to 350 crores, normal risk 250, moderate risk 200, high risk high to 125 crores. Suppose this trust or society other than hospitals and education institutions, in such cases, maximum 100 crores only we can sanction. Same thing earlier I told you, investment IT को finance करने के समय, our finance should not exceed to single investment IT 100 crores because it is a trust. So here also same thing, trust other than hospitals and other than education, 100 crores maximum. And partnership concerns, maximum 125 crores. Limited liability partnership, LLPs, maximum 125 crores. Partnership 125 crores, maximum. LLPs also 125. So these 5-6 points, very frequently it is asked in exam, please keep in mind. Next, definition of unsecured exposure. This is RBI definition only as it is. Ab initio less than 10%. Suppose you are sanctioning a loan of 10 lakh rupees where security is only less than 1 lakh, 50,000 only security you have taken. Or security not at all taken, anyway we call it as a unsecured. But security less than 10% it will taken. 10 lakhs loan ko just 50,000 only taken, that is 5% security. Such cases, less than 10% ab initio from the beginning, if you take, such loans are called as unsecured loans. This is RBI definition. It has come once or twice in exam also. Next, against shares. I told you it is again non-trust area, against shares, and how much amount we can sanction against shares as it is. Accounts covered under CGT MSC. CGT MSC may you are not taking guarantee, but primary security is there. Primary security. So primary security, we cannot treat it as a clean loan. CGT MSC may whatever assets created out of our finance, they are hypothecated or mortgaged to us. So you are taking security. That security for CGT MSC purpose, it is collateral, it is not collateral. Created out of finance is not collateral, it is primary security. That is why for definition purpose, even if you take primary security also, it is secured advance. That is clarification. Okay. Canada budget clean. We need not worry. It is ab initio, no security, clean. Right. Next, individual loans. Loans against individual shares we will give to individuals only, not for business purposes, only to individuals. So how much you can give? Maximum 20 lakhs to an individual, per individual we will give if shares are in demat form. Olden days may physical form may 10, we told 10 lakhs, but now it is not there. We need not worry. So to individuals, loans against share is maximum 1 lakh rupees. Demat, if it is in demat form, security is margin is 25%. And IPOs, somebody is applying for initial public offerings, IPOs, their maximum 10 lakhs we will sanction. Next one is employee option scheme, ESOP, employee stock option scheme. That means company will give at concessional rate to employees. Such shares we sanction them 90%, not 25% margin. Here 10% only margin. So 90% of purchase price we will give. Here also maximum 20 lakhs. This is restrictions regarding loans against shares. So overdraft against property to stockbrokers, I already discussed this. With 40% margin, we will give to stockbrokers overdraft. Next, ceiling in respect of exposure to other banks. If you are giving loans to other banks, earlier we have already discussed this. Public sector as per large exposure framework, already we have discussed. If it is a cooperative bank, again, restricted to 25% of regulatory capital, tier 1 plus tier 2 capital of that bank, our finance should not exceed 25% of that bank's capital. And uska capital adequacy ratio not less than 9%. In such case only we give loan. When the maximum quantum is within 25% of its total capital, cooperative banks. And another one condition also, their net worth should be minimum 1,000 crores. Bus. Next. Exposure to Indian joint ventures, wholly owned subsidiaries abroad. Wholly owned subsidiaries. One company is here. He has floated another one company subsidiary in abroad. And they are subjected to limit of 20% of the bank's unimpaired tied capital funds. So it is not group concept. You have to give in 20% only. Yes, cooperative banks call loans all, sir. Short term, long term, whatever it is. Maximum loan to a cooperative, total exposure, including BGs or whatever it is exposure. Exposure to cooperative banks is restricted to 25% of their capital. Right. Next one, operational process. Now we will go operational process. First one is pricing of credit, rate of interest we fix. Only models you remember for exam purpose. Exposure above 25 crores, grid methodology, that is whatever external rating is there, basing on that, our mapping is there, that grid methodology we will do. Exposure above 2 crores and up to 25 crores, Canara internal rating model, CARM model, basing on that, basing on risk rating, we will charge rate of interest. Above 2 lakhs to 2 crores, again, internal rating model, small value model or manual model, it is there, applicable, whatever applicable, we do as per that. And above 2 lakhs up to 2 crores models, basing on model. Retail lending products as per schematic, up to 2 lakh rupees RBI rate of interest will be advised by bank from time to time. This is about pricing of credit. Next, regarding concessions. Of course, concessions, it is permissible. It is already it is there in our delegation of powers who will permit what percentage, etc. reduction. So whoever permitted these concessions in rate of interest or charges, they are up to what extent they are valid. It is coterminous with original tenability of sanction or till first extension. Tenability we are fixing 12 months in case of OD/OCC, and the rate of interest concession is provided here. So that rate of concession provided is valid up to tenability of loan or till first extension. Another 3 months you are extending. For second extension, concessions are not applicable. That is what. Up to 2 lakhs it is portfolio, above 2 lakhs it is small value. Up to 2 lakhs, including 2 lakhs portfolio. Above 2 lakhs up to 20. Small value. Right, sir. Next one. Accounts where concessional rate of interest is permitted. If it slips to NPA, the rate of interest charged on such accounts shall be contracted rate plus 2%. Nothing but 2% penal charge if it slips to NPA. Bus. Next one. Canara Bank proposal rating, CBPR. CBPR is the credit scoring matrix applicable for corporate loans, 50 crores and above. Earlier we have discussed CBPR. It is system we have to enter 50 crores and above. MSME and agro loans 10 crores and above. Applicability first one. And retail lending, restructured accounts, government accounts exempted. CBPR ratings exempted. Scoring sheet. Basing on scoring sheet, it is a pre-sanction exercise, and basing on scoring sheet, we calculate what type of risk. CBPR 1 aa gaya to low risk we call. CBPR 2 is normal risk. CBPR 3 medium. CBPR 4 high risk. CBPR 5 very high risk. Sometimes in exam they may ask CBPR rating it has 3. CBPR 3 aa gaya. What is the risk? So next, confirmation or approval by executives at RM Wing HO regarding this CBPR rating. Up to CBPR 3 and loans up to 35 crores, DM or AGM, they will confirm. They are at RM Wing HO. And 35 to 250 crores I DGM, above 250 crores AGM. It is up to CBPR 3. CBPR 4 and 5. 5 is no go. High risk account, very high risk account. Up to 35 crores DGM. Beyond 35 crores, it is CGM or GM. Right? Next one, risk rating policy. Risk rating policy, internal ratings and PDs. PD is nothing but probability of default. Already we have earlier discussed probability of default. This is for calculation of our capital. I will discuss again in Basel. Okay. They are based on a 1 year forward looking horizon. That means whatever these ratings are done, basing on 1 year financials, apart from your balance sheet, whatever they have given audited balance sheet figures, and 1 year horizon, next to 1 year, what will be in that horizon, they will do this internal rating. How it will move in next 1 year. Review on annual basis generally. And in case of listed companies and high risk borrowers, review quarterly. This is review of risk rating, generally annual basis in general. But listed companies and high risk borrowers, it is quarterly review. Right? Current borrower rating system. In our bank, what are all the internal ratings applicable for our exposures? For borrower accounts with exposure above 5 crores, Canada internal risk rating model. Earlier, we used to call it as a CRISIL's RAM, but now name is changed as Canada internal rating model. So we have developed this model internally earlier with the help of CRISIL. Now we have developed our own people, CIRM. It is applicable for above 5 crores. Earlier it was above 2 crores. Now in between one more agaya, that is 2 to 5 crores CIRM hybrid model. 2 to 5 crores CIRM hybrid model. What is the difference between CIRM hybrid 2 to 5 crores? Earlier also we were doing. So the main difference between CIRM and CIRM hybrid model is, in CIRM hybrid model, it will take care of your collateral security comfort also. It is not Basel's collateral security. Your land and building, plant and machinery, like that, we are accepting collateral security. It is also a risk mitigant. For capital calculation, it is not applicable because Basel has not recognized as security, land and building or your plant and machinery, etc. Whereas our internal ratings may, if you are accepting that collateral security, if security comfort is there, so it is a risk mitigating measure. That is why that aspect is taken care in Canada CIRM hybrid model. This is the difference. In CIRM model, risk securities there is no weightage. In CIRM hybrid, there is a weightage for securities, which we are accepting collateral securities. That is only difference. So that leverage is given between 2 to 5 crores people, small people. Right. Next one. 20 lakhs to 2 crores, it is manual model. And above 2 lakhs, up to 20 lakhs, above 2 lakhs, up to 20 lakhs, small value model. Loans up to 2 lakhs, that means including 2 lakhs. And some specific exposures having pool characteristics, small loans. It is portfolio model. Wherever there is no requirement of balance sheet, you go under portfolio model. There is no requirement of balance sheet, like individual loans. It includes retail lending, agriculture, ELs, individuals where financial statements are not required. This is the condition, right? Next, regarding CIRM model, if it is a manufacturing sector, basing on turnover 25 crores and above, we do risk rating under large corporate module. If turnover is less than 25 crores for manufacturing sector, risk rating is done under SME module. Similarly, for traders, turnover 25 crores and above, large trader module. If again turnover is less than 25 crores, small trader module. NBFCs, it is NBFC module, right? Next, weightages, how we have given in our each ratings may. For industry ratings, either whether for existing borrowers, here in brackets it is new borrowers, this is for existing borrowers. Industry risk, both existing and new borrowers, 5% is given, industry risk. And business and management risk, for existing 15%, new borrowers 20% weightage is given. Financial risk, for existing 35%, new borrowers 40% is given, financial. Security coverage risk, 30% is for existing and 35% in case of new borrowers. Conduct of account, 15% for existing, new borrowers not applicable as no account. It is new account. Okay. Now, CARM, we have discussed this. Okay, these are all grades we need not worry about. And mapping also it is given. Yes, sir. Some rating model for exposure above 5 crores. Our CIRM model only, because hybrid up to 5 crores only, above 5 crores up to 25 crores. It is CIRM model. Above 5 crores up to 25 crores, CIRM model. But in CIRM also, again, basing on type of customer. Say if it is a manufacturing unit, we do under, that's what here I have explained. If it is a manufacturing unit, we do under corporate module, either large corporate or SME. If it is a trader, large trader or small trader. If it is NBFC, NBFC module, like that. Above 5 crores, we do CIRM under that separate models, basing on type of borrower. Right. This is regarding mapping. Here, manual model 1 or small value model 1, wo to low risk 3 hai. Manual model 2 hai to normal risk. 3 hai to moderate. 4 hai to moderate risk 2. 5 is high risk. 6 high risk 2. 7 high risk 3. 8 default. This is what 8 grades in our manual model or small value model. That is mapping. Which risk grade that? Sometimes 1 to 2 or 2 to 3, they are touching this question also. In olden days, they used to ask marks. A person has got 85 marks. What is the risk grade? 85 and above, in those days, it is low risk. So such questions also, chances are there. Right. Next, risk rating process and confirmation of rating. Who has to do risk rating and who will confirm risk rating? Normally, sanctioning authority, they should not do risk rating. That is what all credit proposals are subject to credit risk assessment by a team of independent of credit origination team. It is not origination team. Team origination means who is a relationship person. This separate. For small value and manual model, approval by concerned sanctioning authority as per delegation of powers. So here, approval authority is same sanctioning authority for manual and small value. LCBs, MCBs, foreign branches, treasury, section in charge will verify and executive set HMRO wing will approve basing on the delegated powers. In case of other branches, up to 35 crores, RM section CO will initiate and HORM they will confirm. Above 35 crores, initiation, verification and approval by RM wing HO. Yes. Next, MSME Sulabs, they shall initiate internal ratings in LAPS package for loans of rupees 2 crores to 35 crores. RM section of CO, they will review and forward to HO for confirmation. So here, mapping of CIRM and external rating. CIRM we are doing and external rating is somebody doing, because RBI has given risk rate, the percentage, 20%, 30% like that. Risk weight is given only for external rating. So our internal ratings are mapped to external ratings. What is that? AAA, AA or A. It is mapped to our CNR 1 to 5. It is low risk considered. And BBB, BBB, CNR 6 normal risk. BB, CNR 7 and 8 moderate risk. B and C, CNR 9, 10, 11 high risk. D is default. This is mapping of CIRM and external. That is internal and external rating. Okay, probability of default 5-year horizon and loss given default 7 years. We need not worry much about this. Next, validity of internal credit risk rating. Earlier also we have discussed this. Whatever risk rating is done now, it is valid up to 15 months from the date of confirmation of rating or 18 months from the date of signing the balance sheet by auditors. This is validity of this risk rating. Afterwards, we should not take any decision basing on this risk rating because it is not valid still. Right? 15 months from the date of confirmation or 18 months from the date of signing balance sheet. This is validity of your risk rating. For retail loans, normally we say more than 70% are considered to be investment grade. This is about retail loans, basing on scorecard borrowers. Next, external ratings may, whether we have to do, two types are there, short-term ratings and long-term ratings. Whether we have to do under short-term or long-term, that we have to decide. This is what scope of application. Exposures with contractual maturity up to 1 year short-term. Here OD OCC, though it is mentioned as up to 1 year, normally OD OCC will be renewed and continued further also. That is why they are done under beyond 1 year long-term ratings. OD OCC and beyond 1 year long-term ratings. This is short-term ratings, right? Next, this is about risk weights. Different is there. Already Basel also it will come. We will go through a little fast this risk weights. What are they? Claims on domestic sovereign means government exposures, government guaranteed, not state government guaranteed, again central government guaranteed, or direct exposure to state government. Claims on RBI, DICCC guaranteed, CGTMSC guaranteed, or all now so many are there schemes, credit guarantee fund for micro units, etc. This is housing, low income housing wala. All these guarantee schemes, wherever they are covering, to the extent of coverage, that means to the extent of guarantee given by central government. Otherwise, we call as to the extent of coverage, 0% risk weight. Right? Beyond that, as applicable to the borrower. Next, guaranteed by state government and claims on ECGC, 20% risk weight. Next, claims on foreign sovereigns, it is again basing on ratings only, AAA or AA, 0, etc. Public sector, again basing on ratings only, 20%, 30%, etc. Short term also basing on ratings. Next, exposure on banks in India basing on CET plus CCB. This is tier 1 capital, common, tier 1 open capital, not additional capital, CET1, common equity capital, and plus CCB, capital conservation buffer, both put together. Ratio 12% if it maintains the applicable CCB. This is on banks, exposure on banks. Suppose if we have given loans to any other banks, what is the risk weight here? That is 20% if they maintain capital. Claims on unrated corporates, asset finance companies, and NBFC, IFCs. NBFC, IFC, they have having aggregate exposure of more than 200 crores from banking system. They will attract a risk weight of 150%. Earlier, they used to say, if it is unrated, you apply 100% risk weight. So what they do, suppose if rating is getting means, or rating may very bad rating aa gaya, it will be 150% risk weight. To avoid that, what some corporates are doing, they will not do rating. Anyway, they will pay that penalty, and 1% or 0.5% rate of interest extra, whatever they pay, they will postpone rating. In such cases, what our Reserve Bank has told, claims on unrated corporates, if they are not doing rupees 200 crores and above, those who are enjoying from banking system total loans 200 crores and above, if they are not rating, then you apply 150% risk weight. Suppose if they are get good rating means they may apply 20% also. Since they have not done rating, up to 150% rating it has come, right? Exposure to CICs, credit information companies, your CRISIL, etc., etc. They will continue to be risk weighted at 100%. All credit information companies, 100%. Next, regarding regulatory capital, regulatory retail. So exposure to regulatory retail, 75% common, it is all a old one only. But classification of regulatory, sometimes they are asking that regulatory retail. One is orientation criteria. Orientation criteria means turnover less than 50 crores in last 3 years. That is one. Average of last 3 years, less than 50 crores turnover. It is orientation criteria. Such loans are called as retail, regulatory retail. Product criteria, small business loans, education loans, etc. That is product criteria. Third one is granularity criteria. What is this granularity criteria? Single loan should not exceed 0.2% of total loan portfolio, retail loan portfolio of the bank. So normally single loan it will not exceed, but RBI guideline. Suppose our bank's total retail loans are 1 lakh crores. 1 lakh crores may 0.2% means how much it come? It is 2% is 2000 crores and 0.2% means 200 crores. So 200 crores it will come for our bank, single loan generally. So that is only just for information purpose only. So granularity criteria may single loan not to exceed 0.2% of overall regulatory retail portfolio of the bank. And last one, exposure, small low value exposure, maximum loan up to 7.5 crores. This change last year. Earlier it was 5 crores, now it is 7.5 crores. Right? This is about regulatory retail where 75% risk weight is applied. Next, residential property. Yeah, most importantly, they are asking in exam regarding residential property. This is basing on loan to value ratio. Loan to value, already I told you, LTV ratio, liability divided by security. Morning we have discussed this. So loan to value up to 80%. That means 20% margin here. Up to 80%, risk weight is 35% only. And margin up to 10% only. This is LTV up to 90%. 50% is risk weight. And standard asset provisioning 0.25 here. Normally it is 0.4, and for agriculture and SME 0.25 they have given. Others point here 0.25 on par with agriculture and micro and small units. Right. Claims classified as commercial real estate, CRE. Morning we have seen what is commercial real estate. So commercial real estate may one is CRE-RH, where below 10% commercial space is there in complex, we call CRE-RH. There, LTV ratio, it is not applicable now. Straight away 75% risk weight and standard asset provisioning 0.75. Commercial real estate, irrespective of LTV, it is risk weight is 100% and standard asset provisioning is 1%. Right? So here for NPS also, basing on provisioning, it is given. If provision to outstanding is less than 20%, it is 150%. That means provisions are less. So 150%. At least 20% provisions are there, 100% risk weight. If provisions are 50% at least, then 50% is risk weight. Where land and building is secured by, NPA is secured by land and building, then 100% risk weight will apply, net of provisions. Where provisions reach at least 15%. For residential property, 100% net of provisions. This is for NPS, not for standard. Standard already we have seen. Right. Next, if specific provisions of such loans at least 20%, but less than 50%, then provision should be 75%. If at least provisions are 50% in case of NPAs, your risk weight also will be 50%. Right. Next one, venture capital funds. Venture capital funds means any new unit somebody is starting. If you are financing, it is venture capital fund. It will attract risk weight of 150% because risk is more. Because it is new type of venture and it may or may not get success. That is why risk weight is more in this venture capital funds, 150% risk weight. Right. Next one. Consumer credit including personal loans. It is 100%. Capital market, it is 125% risk weight, and claims on rated as well as non-rated, non-deposit taking systematically important NBFCs, NBFC, NDSI, other than asset finance companies and IFCs, it is 100% risk weight. I think once they have asked this question, right? Yeah. Okay. Next one. To staff loans. Staff loans, if staff loan is fully secured by superannuation benefit or mortgage of flat or house, it will attract 20% risk weight. If it is not covered by superannuation benefits or not covered by mortgage, then regulatory retail 75% risk weight. So normally what bank is doing in this aspect, while giving loans to staff, bank is taking one undertaking letter covering superannuation benefits so that it will cover our entire service and our loan will be charged 20% risk weight because it is covered by superannuation benefits. Right. Next, in case of Clearing Corporation of India, CCIL, it is settlement for your repo, reverse repo, etc., etc. So there the risk weight will be 20%. Now, Basel recognized securities, all cash margin, bank deposits, gold jewelry. Sometimes they are asking for 1 to 2, which is not Basel recognized security like that. Your land, building, they are all not recognized as securities by Basel. Land, building, plant, machinery, stocks, vehicles, they are not securities as per Basel. Only cash margin, bank deposits, gold jewelry, NSC, KVP, insurance policies, state government and central government securities, units of mutual funds and debt securities. These are only securities as per Basel. So for capital calculation, your exposure minus security value, whatever securities you have taken, all these securities, exposure minus the security value they will take, and for balance only we have to maintain capital. To the extent of security, you need not maintain. But here again, some securities we will not take as it is, some haircut is there. That means on value, certain percentage will be deducted. They will not take as it is, right? Next, Basel recognized guarantees. Basel recognized guarantee by central government, state government, scheduled banks, CGTMSC, ECGC. Now so many all guarantees, guarantees all. This guarantee is National Credit Guarantee Trust Company. It is giving so many guarantees. All these guarantees, Basel has recognized as guarantee. So to the extent of guarantee coverage, you need not maintain capital. That means 0% risk weight to the extent of coverage by these guarantees. Any loan you have given, so many Mudra AO loans you are giving. NCCTC, it is covering guarantee. Mudra loans are covered. So guarantee coverage, in some cases 80% or 90% they are giving. So to that extent, you need not maintain capital. Exemptions, bus. Here also credit guarantee fund for this housing National Housing Bank. Guarantee coverage for eligible borrower is housing loans to individuals up to 2 lakhs, 90% of default or sanctioned amount. This is for small people. National Housing Bank, it is supporting CRG credit guarantee for that small lower income housing loans. And 2 to 8 lakhs, 85% of default, whichever is less. Next, education loans are guaranteed again by CGFSEL, and there up to 7.5 lakhs it is covered. Guarantee is given up to that 5 lakhs, 7.5 lakhs. No need to maintain capital, 0% risk weight. So up to this, it is security, risk weights, etc. Now, last chapter of this policy, we are coming collateral management policy of the bank. Here only two types are important. These two types are there mainly. One is current assets valuation. Second one is fixed assets valuation. But in valuation, one question certainly they will ask. We'll see these valuations. So first one is general condition, inspection of securities. Stock inspection, they say generally every month, but in some schemes, it will be quarterly and half yearly also given. Next, unit business premises, wherever term loans are granted, every quarter it is to be inspected. Vehicles every year should be inspected. This is general term. Again, schematic is separate, right? Collateralized transaction, the exposure amount of risk mitigation is calculated. The exposure amount of risk mitigation will be multiplied by the risk. Okay, it already we told risk weighted assets. For calculation, already it is discussed. Bank may apply zero haircut for eligible collateral where it is national saving. I told you, without any reduction in security value, we will take for NSCs, Kisan Vikas Patra, surrender value of insurance policies, and bank's own deposit. Here there is no haircut. As it is, full value we will take. Whereas for gold, we will reduce some amount. Percentage it is given. Next, now we go for valuation. Stock audit. This is what otherwise called as stock current assets valuation by outside valuers or chartered accountants or valuers in our panel. This is what stock audit. So first one, applicability. 5 crores and above once in a year for low risk and normal risk. Applicability 5 crores and above once in a year for low risk and normal risk. Moderate risk accounts 1 crore and above once in a year. Normally, stock audit is once in a year. It is common guideline. Except substandard and doubtful less than 5 crores, it is once in a year. For substandard assets and doubtful less than 5 crores, it is once in 2 years. Remaining all cases, doubtful assets 5 crores and above, again once in a year. First, next one, cutoff limit is For low risk and normal risk, it is 5 crores. Moderate risk and high risk, it is 1 crore and above. Substandard assets, NPS also 1 crore and above. Bas. This is about, and stock audit is exempted for accounts covered under special agencies for specialized. Morning we have seen ASMs, that is 250 crores and above limits. We will engage one chartered accountant or outside agencies. They will do quarterly monitoring. That is why stock audit is not applicable. Since they are doing quarterly, why again yearly? Double, right? Next, fixed assets valuation. Fixed assets of the borrower, that is land and building, plant and machinery, etc. Valuation is once in 3 years. Here. Next, in respect of fixed assets, mortgage loan accounts classified, all housing loan variants once in 5 years. Normally fixed assets once in 3 years, all housing loan variants 50 lakhs and above once in 5 years, every 5 years. Next, 10 crores and above properties by 2 valuers. This several times they asked this question. Property value 10 crores and above, it is done by 2 valuers, 2 independent valuers. Whereas in case of NPA, surface may 5 crores only cut-off limit. It should be done by 2 valuers, right? Valuation of only landed property without any superstructure. Here we will take only acquisition cost as per registered sale deed. If it is acquired within 1 year. So previous 1 year mein kharid liya, only you take acquisition cost, registered sale deed mein hota, that only you take. Because it is only landed property, no structure is there. So engineer ka jarurat nahi hai. Straight away, you take whatever they have mentioned in the registered sale deed. If acquired beyond 1 year, 85% of the market value you take, right? If property is acquired by gift or will settlement deed, here no amount will be mentioned in gift deed. In such cases, guideline rate from sub-register office to be considered. Somebody has says, sir, I have taken land gift deed. Wo to mera father or father's father, somebody has gifted. No value. So that is why guideline value you have to take. It is open land again. Next, valuation of sugar stocks. I told you sugar stocks only now in SCCs, selective credit commodities, may only sugar stocks are included at present. Here, unreleased stocks of levy sugar. That means it is meant for levy sugar, but unreleased, still it is in godowns. In such cases, levy price fixed by government. And free sugar, it is not meant for levy, it is meant for open markets. In such cases, average price in preceding 3 months or current market price, whichever is lower, you have to take, because there will be more fluctuations. To avoid this condition has given. This is valuation of sugar stocks. Regarding agricultural lands, plantations, etc. Valuation of agricultural lands with structures. Just like our land and building, what we are building, we are doing same similar here once in 3 years. If no superstructure is there, poultry shed aisa kuch bhi nahi hai, only open lands, it is once in 5 years in agriculture. But in general advances, either open land or construction once in 3 years. In agriculture, if construction is there once in 3 years, if construction is not there once in 5 years, that is the difference between these two. AUOs and AU promoting managers, they can do valuation of lands for limits up to 30 lakhs. Here not land valuation, this is limit up to 30 lakhs. They can do valuation, whatever may be the value of the land. And other managers, that is agricultural loans, up to other managers, they can do limit up to 20 lakhs. Here, maybe value of land maybe 1 crore or 2 crores, but limit is 20 lakhs only. Then general managers, other than AEOs also, they can do, right? Next, here also 10 crores and above, it should be done by 2 independent valuations, valuation from 2 independent empaneled valuers, 10 crores and above. This is common guideline for both general as well as agriculture. Next, it is suggested that minimum gap between 2 valuations should be 3 years. If carried out at frequency lesser than 3 years, then value of property shall be taken at 85% of the present value of the property, and valuation shall be carried out by other valuer who has done not say this. Normally, what is there? Once in a 3 years only valuation has to do. That's what we are telling. But in some cases, some branches earlier they used to do. Pati aa gaya sir, hamara value बढ़ gaya pura. Within 1 year, very much grown. because of real estate boom. Now our valuation is more, so you enhance my limit. Such cases aa gaya to, with below 3 years we may go for valuation. In such cases, don't take as it is full value given by that engineer or valuer. You take 85% of the present value, whatever they have given. Out of that 85% only you consider, not full value. And moreover, present valuation should be done by other valuer. That means who has not valued earlier. Earlier somebody has valued, usko nahi dena, dusra aadmi se value karwana. So these are regarding collateral management policy. So with this, we have concluded CRM policy. Since the CRM policy is a little important for all, not only for exam, but also for interview also important. That is why we have taken a little more and in detail. Now what we'll do before going for next topic, because next I will start Basel 3, I will start. Before going to the next topic, we break for tea for 15 minutes. Now it is 3:25. We assemble here exactly by 3:40 so that we will dispose well by 5 o'clock. Okay, sir. Shall we break for tea? Tea break for 15 minutes. Yes, sir. Tea break for 15 minutes. (3:25 PM to 3:40 PM). Yes, sir. Yeah. We break for tea, sir. Sir, tea break there because policy is completed. After tea break, I will continue Basel, sir. 3:40, I will continue Basel. Thank you, sir. Thank you. Yeah. Promotion personal, yes, sir. Yeah. So now we will start another important yes, sir. Shall we continue our
Yes, sir.
session? Yes, yes. So now Basel 3. Morning we have seen at the time of our starting risk management class, what is the importance of Basel. So expected losses we are covering by way of pricing and provisioning. Rate of interest may and provision dono mein we are covering. Whereas unexpected losses means beyond expected. Expected losses we are calculating through probability of default, exposure at default, and loss given default. We are calculating through internal ratings based approach, etc. And we are taking care. But beyond expected losses, if losses are there, we call them as unexpected losses. So these unexpected losses are to be covered by your own capital. That is called, Basel has called, you maintain capital to take care of unexpected losses and don't pass on that losses to the customers, depositors. That is why this rate, the capital rate is prescribed in Basel. Now Basel 1, 2, we will not discuss now. Basel 3, regarding Basel 3. It aims at enhancing banking sector's ability to absorb shocks arising from financial and economic stress, improve risk management and governance, as well as strengthen banks' transparency and disclosure standards. Now we'll see one by one, what is the regulatory capital. 3 pillars as it is: minimum capital requirements or minimum capital standards, whatever you call, first one. Second one, supervisory review. That is internal capital adequacy assessment process and supervisory review and evaluation process. Both are there in that supervisory review. And the third one is market discipline. So here, supervisory review and market discipline, not much to talk about. Simply, market discipline means disclosures. What Reserve Bank says, you have to disclose your important ratios. your capital kitna, or capital CAR, capital adequacy ratio kitna, NPS kitna, like that, you have to disclose at least half yearly. Where to disclose? In our website or public domain. So this is what market discipline, except that nothing is there. We need not worry for exam purpose, market discipline. Regarding supervisory review, in supervisory review, that's the internal capital adequacy assessment process. Reserve Bank will review on-site and off-site monitoring both, how you are calculating your capital, how you are assessing. And supervisory review and evaluation process, both in here, the thing is, your risk-based internal audit, it will come into the picture, RBIA. Anyway, RBIA is separated debt, so that we need not worry. Now, main pillar is minimum capital requirement or minimum capital standards, first one. Right? Now, apart from this, in Basel III, few more issues are there. One is liquidity coverage ratio, net stable funding ratio, leverage ratio, capital conservation buffer, and counter-cyclical capital buffer. These 4 issues are there. And regarding these 4 also, we will discuss one by one. First, we will see regulatory capital. What capital, how much capital you have to maintain? Says total capital ratio. It is Tier 1 capital plus Tier 2 capital divided by risk-weighted assets. Which risk-weighted assets? All 3 types of risks you have to take care. That is credit risk plus marketing risk plus operational risk. So all 3 types of risk-weighted assets, you have to take place all these things, right? So capital adequacy ratio, how much it should be Tier 1 capital and Tier capital in proportion to risk-weighted assets. Originally, they says 9% banks have to maintain total capital. Plus in Basel III, they have included capital conservation buffer. That is 2.5% capital conservation buffer they have included. And Basel says 9, as per Basel 8% only, plus CCB added. But our bank, Reserve Bank, says 9% capital we have to maintain, plus 2.5% capital conservation buffer, total 11.5% capital we have to maintain. Banks are supposed to maintain. This is what Basel has prescribed. Anyway, our bank has crossed more than 14.6%. Right? Now, regarding this capital mein components of capital, first one is Tier 1 capital mein common equity Tier 1. It should be minimum 5.5%. Again, in this percentage, what they says, Tier 1 capital should be minimum 7%. Tier 2 capital can be maximum 2%. Here you have to remember minimum 2%, maximum minimum 7% Tier 1, maximum 2% Tier 2. So in Tier 1 capital, again, first one is core capital or common equity. And another name is also called for Tier 1 capital is also called as going concern capital. Going concern capital. Here I have mentioned here. Tier 2 capital is called as gone concern capital. Going concern capital is Tier 1. Gone concern capital is Tier 2. So Tier 1 capital, common equity should be 5.5% minimum. And additional Tier 1, it can be maximum 1.5. Common equity means own money plus reserves, etc., etc. And additional Tier 1 means subordinated bonds, what you are getting. And earlier we have discussed subordinated bonds we are taking. That is what Tier 1 bonds we call here. So this is Tier 1 capital, both Tier 1 equity and Tier 1 additional bonds put together 7%. And Tier 2 capital maximum 2%. Both total capital requirement is 9%. Apart from this, Basel III has prescribed you maintain capital conservation buffer 2%. What is this capital conservation buffer again? Capital conservation buffer means what Basel says, when your business is normal and going on without any stress, market, there is no stress in the market or business going on smoothly, that is good times. During those times, you built up some capital. During normal periods, you built up some capital, which will take care of your additional funding or excess funding during stress time or difficult times. So normal cases में थोड़ा बच करो, you save something so that it will be useful for future. It is called as capital conservation buffer. This capital conservation buffer should be in the form of common equity tier 1 only, not additional one. Common equity tier 1. 7 or 9% what? There is a query. 7% is tier 1 capital and 2% is tier 2 capital. Total capital is 9%. As per Basel, it is 8% only, but at international level. As per Reserve Bank of India, we have to maintain 9%. In Basel 2 also, international norm was 8%, Indian norm was 9%. Now it is continued. So now total capital is 9%. Out of the tier 1 capital is 7%. And here again, I will clarify one internal doubt somebody has raised, that I will tell you. What Basel says is, your own equity, that is apana paisa, what I told you, no, not additional borrowed one. Your own money should be 5.5% here. That is what? T1 capital common equity. And capital conservation buffer, whatever it is there, 2.5% capital conservation buffer, it will be part of your common equity because these are all reserves. Out of your profits, whatever you are earning, these profits you save for future. So retained profits, where these retained profits will go, it will go to your common equity only because it is your own money now. You need not distribute to shareholders. Retained profits. So these retained profits will be part of this tier 1. So what happens after CCB? Your tier 1 common equity will be 5.50% plus 2.50%. It will be 8% here, including CCB. This is what clarification. Normally in books, different rates will be there. For that, I am clarifying. RWA is risk-weighted assets. RWA, risk-weighted assets. Right. So now I told you, total as per Basel 3, we have to maintain 11.5% capital. Out of 11.5%, 7% plus 2.5, 9.5% should be tier 1 after capital conservation buffer. Because earlier capital conservation buffer, it was 0.625 less was there. Now that time is also over. Now fully you have to maintain. So 2.5% we have to maintain. 2.5 plus 7. 9.5% should be tier 1 capital and 2% should be tier 2 capital. Total capital is 11.5. Right? Now clear? Usme, if they ask total common equity including the capital conservation buffer, common equity capital conservation buffer 5.5% plus 2.5%, it is 8%. They go to. So common equity should be 8% with buffer. And additional tier 1 is 1.5. That becomes 9.5 plus tier 2 capital 2%. So total is 11.5%. This is what Basel 3 ka what capital you have to maintain total. Right? Now, we go for what are all the components in tier 1 capital, because they are asking questions everywhere. This is only simply 2 to 3 pages Basel I have prepared. In this only they are asking questions, either 1 or 2 or sometimes 3-4 questions also. Last year I have seen in 3 to 4 or 4 to 5. Some 3-4 questions are there in this 2-3 pages. So that much importance it is given at higher level. Okay. Now, elements of tier 1 capital. Sometimes they may ask, what is going concern capital? That is tier 1 capital. Gone concern capital is tier 2 capital. Now, elements of tier 1 capital. First one is common shares, paid up equity capital. This is first one, foremost. Paid up capital, equity capital. And the second one is stock surplus or share premium on account of issue of common shares. Whenever we are issuing share capital, some premium also we are keeping. That premium will become part of our tier 1 capital. This is what share premium. Next one, statutory reserves. What is the statutory reserves? As per Banking Regulation Act, every bank has to keep 20% of its profits. You add to reserves account before declaration of dividend. This 20% has been enhanced by Reserve Bank of India to 25%. So now, as per BR Act, 25% of your profits before declaration of dividend, you have to transfer to your reserves account. It is called as statutory reserves. This is also recalled question, right? 25% straight away you transfer before declaration of dividend. So this is tier 1 capital. Next one. Next, capital reserves representing surplus arising out of sale proceeds of assets. What is the surplus arising out of sale proceeds of assets? During normal course of business, we might have occurred, we might have taken some assets. Say, for example, I will tell you, in SurfaceE, first auction is over, nobody has come for bidding. Second auction is over, nobody has come for bidding. And now bank is eligible to go for bidding if it is more than 100 lakhs. Two biddings are over. Then we can go and bid ourselves. We can purchase that asset, provided if it is a useful for bank, or if it is one bank use, no issue. We need not worry now. If it is not useful bank, then we have to dispose of that asset within 7 years. Otherwise, again, BR Act will not agree that. So whatever assets you are acquiring, if it is not meant for your own use, you should dispose of that within 7 years. RBI may extend by another 5 years. So within 7 years, you have to dispose of. Now you have acquired one asset through SurfaceE at present. 3-4 years you have retained, it is not for own use. Now you are supposed to dispose of. Market rate acha aa gaya, the asset has sold for good value. There you earned some higher amount. Say you have acquired the asset for 5 crores. Now asset has gone for 10 crores. It is not borrower's asset. Already 3 saal ho gaya, we have taken ownership is Canara Bank now. We need not share this amount to the other person because he is not owner now. So this additional amount, whatever you have received, straight away it is your own money. You add to tier 1 capital. This is what capital reserves representing surplus arising out of sale proceeds of assets, right? Next, other disclosed free reserves, if any, other than these 4, any disclosed free reserves. Free reserves means they are not meant for distribution to any purpose or anybody. So such free reserves are there, that also will be included under tier 1 capital. Next, balance in P&L account of the previous financial year. P&L account of previous financial. What balance in P&L account? It is profit. Profit normally we add it to reserves account. So it is nothing but previous year's reserves, right? Balance in previous year's account. P&L account, financial. Next, revaluation reserves. Here, this several times they asked this question. Previously, it was in tier 2. Now it is moved to tier 1. So revaluation reserves means we are, example for understanding purpose, I will tell you, we are having an asset in Bangalore. Suppose take for example, our own head office, Bangalore. It is purchased long back, olden days. So maybe in book, its value may be 1 lakh or 1 crore. Say, samajh lijiye 1 crore is in book. But as on date, market value will be hundreds of crores or thousands of crores. So the value is very vast. If you take your book value as on today, it is not fair. Now accounting practices also, they says, no, you don't take that value. You go for market value. Again, conditions. So market value, if you take, that is also not fair, because today market is good. It may, in future, it may come down also. That is why via media, what they says, you take this revaluation reserves at the discount of 55% and you consider 45%. For example, only I will tell you, suppose if our building is 1000 crores value, out of 1000 crores, for your balance sheet or for your capital, don't take 1000 crores as it is. You discount at 55%. So take it at 45%. That means you take 450 crores only as your tier 1 capital. This is what revaluation reserves. Next, Foreign currency translation reserves. This is difference between, we will be having some assets in foreign, our foreign branches are there, their assets are there, here assets are there. So this translation difference, whatever it is there, for that purpose, reserves are maintained. That at the rate of 25% discount we have to take. Foreign assets translation reserves. Next, current year profits can be reckoned on quarterly basis. Previous year as it is, we are taking under reserves as it is coming under our reserves, tier 1 capital. And current year profits also you can take on quarterly basis, provided here condition is there. What is that condition? Previous year may 4 quarters are there. Suppose we might have earned 1000 crores profit. For example, only I am telling because our profit is much more. 1000 crores profit you might have earned last year. So quarterly divide 4 quarters, each quarter how much? 250 crores each quarter. 250 crores. Suppose in one quarter it is 100 crores, in second quarter it is 400 crores. That means there is a variation in one quarter more than 25% of average. Average 250. Average is 250. Usme 25% is maybe around 60 and odd. So 400 crores is more than this. There is variation. So if there is variation of more than 25%, don't consider current year's profits. Average profit say, if any quarter may, if variation is there above 25%, this year profits don't take. In any of previous 4 quarters, variation is less than 25% profit may. Say 250 crores is average, and one quarter may 200 crores aa gaya, and another quarter may 300 aa gaya. So here variation is less than 25, maybe 20% only variation. In such case, no problem. You consider current year's profits also. So this is regarding accepting current year's profits towards your tier 1 capital, right? Next, deferred tax assets arising due to timing differences may be recognized as CET capital up to 25%, up to 10% of bank's CET1 capital. So deferred tax assets, say they are receivables from government, because sometimes taxes, we have to claim back some taxes. It may take some time for getting. This is what deferred tax assets, receivables. We don't know when it will come. That is timing differences. So up to 10% of bank tier 1 capital, whatever is the quantum, if it is below 10% of our capital, you accept full amount. If it is more than, if deferred tax assets are more than 10% of our capital, then don't take that exceeding portion. So here capital, consideration under capital is restricted to 10% of bank's tier 1 capital. Earlier we have taken example as tier 1 capital 1 lakh crores. So here 1 lakh may 10% is 10,000 crores. If receivables from government is more than 10,000 crores, then you take capital as 10,000 crores only. If receivables is 8,000 crores only, so entire 8,000 crores is considered under tier 1 capital. This is what deferred tax assets are. So here in this last year, they asked this question for 2 to 3 or 3 to 4. One, it has come. Foreign currency translation reserves, at what discount bank will take? And this question some 10-15 times I have seen this question in this, right? Yeah. Risk weighted assets. Somebody asked NPA ka kaisa. Total assets we are telling here. Risk weighted assets may performing assets also will come. NPS also will come. NPS ka risk weight separately we have dealt earlier. If provisions are less than 20%, their risk weight is 150%. We have seen. So like that we have to calculate risk weighted assets and include here. NPS also part of this risk weighted assets. Right. Next one. Now, additional tier 1 capital we are going. What is additional tier 1? First one is perpetual non-cumulative preference shares, PNPS. Perpetual means without maturity. It is continuous, perpetual. Non-cumulative preference shares. Non-cumulative, that means income they will be distributing. Preference shares, they are convertible in future as shares. So perpetual non-cumulative preference shares, they are included under tier 1 capital because in future they may be included under your equity, common equity. So that is one. Second one, stock surplus. So while issuing these preference shares, any premium is collected, that is part of this one. Stock surplus resulting from the issue of instruments included in additional tier 1 capital. Stock surplus, this is premium. So this is issuing, how much issued, this is one. Second one is premium. And third one, debt capital instruments in additional tier 1 capital. So what are all the eligibility for inclusion under a tier 1 capital? Those instruments we will be including here. That is again innovative perpetual debt instruments, IPDA. The name is given innovative perpetual, again here without maturity debt instruments. So here this is mentioned as without any perpetual, without any maturity. So we are considering under tier 1 capital. Again, tier 1 guidelines it is meeting. That is why. So here exam question several times appeared is first one, this IPDA perpetual IPDA innovative perpetual debt instruments are included up to 15% of tier 1 capital. So these restrictions, suppose if they are more than 15% means they are not included under tier 1, it will go to tier 2. That is why innovative perpetual debt instrument, it is restricted to 15% of tier 1 capital. This question has come. And second question, these instruments along with the PNCPS, perpetual non-cumulative preference shares. So A and C both put together should not exceed 40% of our tier 1 capital. So C should not exceed 15% of tier 1 capital. Both A and C should not exceed 40% of tier 1 capital. These both questions appeared in exam. Right? Next. Now we go for elements of tier 2 capital. Elements of tier 2 capital. General provisions and loss reserves. What are the general provisions and loss reserves? General provisions and standard assets. Wherever bank is identified loss in the assets and you are keeping to that extent, that is separate. That is under provisions we are mentioning and we are netting from NPS, etc. But in general provisions, in standard assets, on standard assets you are keeping provision where loss is not identified. So you have not identified loss and keeping provisions. These provisions are addition. That is why they can be included under tier 2 capital. This is again RBI guideline. Okay. First, general provisions and loss. General provisions on standard assets. Floating provisions. Floating provisions means wherever we are keeping provisions beyond requirement. For example, substandard secured asset 15% is provision normally. So without considering any security, straight away on liability, you have to calculate 15%. With RBI permission, we may go for additional provisions. Now our situation is very good. So we keep instead of 15%, we keep 20% on substandard assets for current year or 2 years, whatever it is. If RBI permits, we may go for that additional provision. So floating, that is called floating provision. Beyond requirement, wherever we are keeping provisions with the permission of Reserve Bank of India, they are called as floating provisions. That means beyond requirements we are keeping. Since we are sound now, we are keeping. That is what floating provisions. Next, provisions held for country exposures. This is separate provisions to different countries exposure. As per guidelines, we will be keeping. Plus investment reserve account. This is also regarding market risk. This will come. Investment reserve account we have to create separately. Whereas in investment, any losses, it will take care. Since already losses are incurred, so here it will be included here. Excess provisions arising on account of sale of NPAs here. How this excess provision will come in sale of NPAs? Suppose one loss asset. Already 100% you have provided already. And now in that last year or last before year you provided. This year you are recovering some 1 crore in this NPA. So already you have kept provision here. Now this with 1 crore payment, this account is closed. So where you will keep that excess provision already kept one, that provision we will keep in this tier 2. This is what on account of sale of NPAs. And then now we are selling it to, we are selling it to ARCs, asset reconstruction companies. Their remaining some provision is left over after transferring to asset company as ARC. Such provisions it will come here on account of sale of NPAs. And counter cyclical provisioning buffer. This counter cyclical provisioning buffer, again, what is this is Reserve Bank says at present you keep provision. What is that buffer? Capital conservation buffer 2.5% as per Basel III already introduced. And internationally, what Basel says, in future, you have to maintain 0 to 2.5% counter cyclical provisioning buffer. In future, whenever required, banks are supposed to maintain counter cyclical provisioning buffer ranging from 0 to 2.5%. It is telling, I will tell you whether 1% or 2%, maximum 2.5% I will tell. So you have to maintain that buffer in future, not immediately. For that purpose itself, long back, what Reserve Bank has told, from 2010 September onwards, Reserve Bank ne bola, you maintain provision coverage ratio, PCR. What is the provision coverage ratio? Total provisions divided by your NPA, 70% you maintain. Of course, our provisions are more than 80% as on today. So Reserve Bank says, you maintain provision coverage ratio 70% minimum in relation to your NPAs. For that purpose, we have already started keeping additional provisions to take care. Since I told you ours is 85%. So that will be helpful for this building counter cyclical provisioning buffer. And this is for future. Here also nothing but in good times you save more, in bad times it will be useful for you. Bas, it's now. Up to now, what they says, this total whatever general provisions, loss reserves, ye sab hai na, these are all restricted to 1.25% of your risk weighted assets. This is several times it appeared in exam, but it is as per standardized approach. As per standardized approach. Again, what is the standardized approach? At present, for 3 types of I will tell you a little later for understanding. Tier 2 na, standardized approach. Here, Reserve Bank ne credit risk measurement 2 types it has told. One is standardized approach and second one is IRB, internal ratings based approach. Again in IRB, 2 types are there. One is foundation, second one is advanced. So if you migrate to advanced internal ratings based approach, you can calculate your own provisioning basing on your risk assessment. So you do risk rating and fix provisioning for this. How much provision, what is the risk weight for this and how much provision I have to keep. You only decide. That is under IRB approach, internal ratings based approach. And once you migrate to IRB approach, you cannot come back to standardized approach. This is what, with RBI permission, if you migrate to IRB, you cannot go back to standardized. So what it says, after joining intermediate, you cannot go again and sit in 10th class. That is what implied here, right? So here, what is the restriction? Under 10th class, that is standardized approach, maximum up to 1.25% of the risk-weighted assets. So total these, whatever reserves are there, provisions, all these provisions up to maximum 1.25% of the risk-weighted assets, you can keep under tier 2 capital. That means if your risk-weighted assets, total our assets may be out of 20 lakh crores, our advances may be around 9 lakh. I am not exactly, I am not aware, but approximately I am telling our assets may be 9 lakh crores. Out of 9 lakh crores, if you multiply that with risk weights, various loans with risk weights you have to multiply. It may come down to 4 lakh crores or so approximately, I am telling. So on 4 lakh crores, what is 1.25%? 4 lakh crores may 4 lakh crore, 5,000 crores it will come approximately. So only all these reserves up to 5,000 crores only you consider under tier 2 capital. If these reserves are more than 5,000 crores, you cannot include under this tier 2 capital. It will go to other liabilities. Oh, for this you include. That is the ceiling for this under standardized method. But now this another one important one. We are already in the process of migrating to IRB approach. If you fully migrate to IRB approach, internal ratings based approach, you have to accept not 1.25, 0.6% of credit risk weighted assets only you have to consider. And moreover, it is not all provisions, 0.6% maybe, not all provisions. What they say is, you are calculating total expected losses. You are having this figure. Total expected losses we are calculating basing on our risk rating exercise, etc. We are calculating total expected losses. And basing on this, we are doing pricing and provisioning, etc. We need not worry. And apart from expected losses, you are having figure of all the general provisions and loss reserves with you. All this figure. So if these provisions are more than expected losses, then it is surplus only. If provisions are more than expected losses, the differential amount, that is more than expected losses, whatever figure is there. Say for example, take earlier in our example, 4 lakh crores is your risk weighted assets. 4 lakh crores. So 4 lakh crores may what they say, general provisions and loss reserves. Approximately general provisions and loss reserves may be 10,000 crores approximately. And your expected losses are 5,000 crores. Expected loss as per our calculation. This is also available. So general provisions is 10,000 crores. Here it is 5,000 crores only. Difference is 5,000 crores. Excess. That 5,000 crores only is eligible for tier 2 capital. But here again, not entire amount, 0.6% of credit risk weighted assets. What is this 0.6%? Earlier example में 4 lakh crores is your credit risk weighted assets. उसमें 0.6 का मतलब 2.4 crores, I think, 2.4 lakhs it will come. For 2.4 crores. So here we are telling 500 crores and here 2.4 crores. So entire amount you can take under risk weighted assets. This is what. That means if your provisions, general provisions and loss reserves are more than expected losses, the differential figure, that is what more than expected losses, that figure, that amount you can consider under tier 2 capital. Again here subject to maximum 0.6% of credit risk weighted assets only. Suppose if provisions are lesser than expected loss, that means loss you are expecting more, to that extent provisions are not there, then there is no question of your including under tier 2 capital. This itself is deficit. So this you reduce from capital directly because you are expecting less. This will affect your capital. So no question of adding to capital here, right? This is what important at higher level, this 0.6%. Already this has come once or twice in exam. Earlier this was come. So this 0.6 also appeared in exam 2-3 times, right? Next, debt capital instruments issued by banks. Debt capital instruments. It is nothing but for tier 2. Recently, we might have seen in press, our bank also has raised some amount under tier 1 capital and tier 2 capital. That is additional tier 1 and additional tier 2. Of course, it is appearing in our press release also last year. You might have seen recently that September results. It is there. Okay. This is what debt capital instrument issued by banks. We are issuing bonds and collecting funds from public. This is long term. That is why it is included under tier 2 capital. And preference share capital instruments. Here in tier 1 also we have seen preference share capital, perpetual cumulative preference shares. Here, perpetual cumulative preference shares plus redeemable non-cumulative preference shares plus redeemable cumulative preference shares. So these three types, they are also different types of bonds only. Though name is mentioned as shares, it is bonds only because they are not convertible. Okay, so this is also bonds, these are also bonds, some with different characters. So under tier 2, debt capital instruments are there, PNCPS, PCPS, perpetual cumulative preference shares, redeemable non-cumulative preference shares, redeemable cumulative preference shares. So 4 types of bonds are there here, plus stock surplus, that is share premium from instrument included in tier 2 capital. While issuing these type of instrument, wherever share premium is there, that also you have to include under this tier 2 capital. So 4 components in tier 2 capital. One is your general provisions and loss reserves. Second one, debt capital instrument. Third one is PCPS, RNCPS and RCPS. And fourth one is stocks share premium on issue of above bonds. So PCPS is perpetual in nature. That means there is no maturity is mentioned here. But only thing is there is no call option, but put option is there. That means banks can give them back after 5 years at RBI with RBI permission. This is what redeemable non-cumulative preference shares and redeemable cumulative preference shares, they have fixed maturity with minimum 5 years. Call option can be exercised only after the instrument has run for at least 5 years. For this, call option is there. For perpetual, it is only put option. And now we go for another important question regarding this. I think 2-3 years back, all 3 exams, they gave the same question with different years. That we will discuss now. What is that? The value of redeemable instrument is taken at a discount based on remaining period as below. While considering redeemable instruments under tier 2 capital, if the remaining period is less than 5 years, why we are telling the bond should have minimum maturity of remaining 5 years, then only we will take it as a bond tier 2 capital fully. Suppose already old bonds, now it has period has run. Now remaining maturity is less than 5 years. In such case, we should not take full bond value basing on remaining maturity period. The bond value is to be reduced. That is what a discounted price. What is that bond value? We will see. If remaining maturity is less than 1 year, remaining maturity, that means 100% discount. So no value we will take because it is maturing in less than 1 year. If it is maturing in more than 1 year, then only we will count. If it is maturing in less than 1 year, no counting under tier 2. Next one, it is maturing in more than 1 year but less than 2 years. You take bond value at 80% discount. Suppose 1000 crores bond value, it is maturing in another 1.5 year. In such case, you discount 80%. That means 1000 crores may 80%, 800 crores you discount and accept, take it as 200 crores only under tier 2. Because discount is 80% since maturity is less than 2 years, above 1 year. And 2 to 3 years, I thought 60% discount. 3 to 4 years, I thought 40% discount. And 4 years and above, but less than 5 years is remaining maturity. Then 20% is discount. In previous example, out of 1000 crores, 1200 we will reduce discount and 800 crores we take as tier 2 capital. So these discounted rates they have given percentage wise for exams, all 3 exams they asked in I think 2 to 3 years back. Next, measurement. This is also their touching question. Measure credit risk in which credit risk is measured under which method? This is what. So basic method, earlier standardized method, now we are following. What is standardized method? In standardized method, Reserve Bank has prescribed, these are all risk weights. If you go for external rating, if AAA rating aa gaya to you apply 20% risk weight. This Reserve Bank has given. We have not calculated. So under standardized method, Reserve Bank has given different type of risk weights. Regulatory retail, Reserve Bank says 75%. You calculate accordingly. So regulator has prescribed this risk weights. So it is standardized method we call. In internal ratings based approach, we have to measure our internal ratings. CIRM, we are counting now up to 25 crores. If you take permission from RBI, your CIRM is eligible for risk weight purpose also. So in CIRM, if your account has come low risk, then you apply low risk, either 20% or 30% or 50%, basing on mapping. So this is what internal ratings based approach. इसमें I told you, one is foundation approach, second one is advanced approach. Internal ratings में we have to migrate to advanced approach. Then only RBI will give permission for applying our own risk weights. This is about credit risk. So question is, at present credit risk is measured under which method? Otherwise they may ask, which is the advanced measurement method for credit risk? It is IRB. Market risk. Market risk is measured under standardized duration method and internal model approach. Two methods. Operational risk. Here they asked several times this operational risk. First operational risk, they asked definition. Definition is failure of systems and procedures, hardware and software, which may be due to internal or external factors. Loss arising out of external factors or internal factors or failure out of systems, etc. This is what operational risk. And what is market risk again? Changes in the interest rate affecting the yield on investment method of measurement. We are investing in government bonds and other bonds, etc. Their changes in the interest rate, it will affect the yield. That is what market risk. So operational risk is failure of systems, process, etc., etc. And operational risk method. Yeah, this sheet recently only I prepared. I will share with our sir. It is already available with Ravi, and I think he might have kept in group also. This will be shared, sir. Whatever I am telling, it will be shared. I will send it to Ananta Krishnan sir, and he will also share. And Ravi also is giving in that common promotion group. It will be given to all. Okay. Next, operational risk. Operational risk, three types of approaches are there. One is basic indicator approach. Second one is standardized approach. And third one, advanced measurement approach. We are following basic indicator approach. What is this basic indicator approach? Basic indicator approach, Reserve Bank has given here again. Basic indicator is 15% alpha. What is this 15%? Previous 3 years profits, gross profits you take, and average, you do average and multiply with 15%. You will get indicator, basic indicator. That is, what is basic indicator? Previous 3 years average gross profit multiplied by 15%. This is what basic indicator. And to arrive capital, you again multiply it with 12.5. So here basic indicator is 15% of previous 3 years gross profits. This is what indicator given by Reserve Bank of India. This is approach for measurement of operational risk. So this is one. In future, we have to go for this advanced approaches. For this again, incident reporting, etc., bank has already introduced. So what are all frauds have taken place? What are all the incidents happened? All this will be counted and calculated for operational risk for advanced approaches. This is about 3 methods. Now, important risk weights we will go through. What are all the risk weights? Cash and bank balances with reserve. Morning also we have seen this 0% risk weight, central government exposures, etc. Banks 20% where they are maintaining CRAR. Next one, government approved securities 2.5% risk weight. Staff loans I told you 20 or 75. Consumer credit 100%. Capital markets, credit cards 125%. Credit cards, it is taken separately from consumer credit and they brought under 125%. You have to keep in mind. And venture capital funds, it is 150%. Regulated retail, I told you it is 75% retail. Next, credit conversion factor for non-fund based limits, NFBs. Financial guarantees, DPGs, advance payment guarantees, because these are all financial guarantees, it's 100%. That means if you have given guarantee of 10 crores under financial guarantees, that is DPG or APG, their entire amount you take for calculation of capital. So there is no conversion. 100% you take as liability. Whereas bid bond guarantee and performance guarantees for calculation of capital, only you take 50% of value. Suppose 10 crores ka guarantee, you have given performance guarantee. For calculation of capital, you multiply with 50%. So 5 crores only you take for capital calculation. This is what credit conversion factor for non-fund based limits, right? Next, regulatory retail, already we have discussed this 3 times. We come for capital conservation buffer. Yes, sir. Yeah. Regulatory retail means Reserve Bank has told small loans, all small loans, you cannot calculate individual risk weight because they are very much more in number. That is why instead of individually calculating risk weight, you calculate as a portfolio as a whole and you apply the risk weights given by Reserve Bank of India. So for regulatory retail portfolio, they have told what are all regulatory retail portfolio. One is I told you previous 3 years turnover not exceeding 50 crores average turnover, number one. Number two, small exposures like small loans. Number two, just amount they have not given any. And third one is single loan should not exceed 0.2% of total regulatory retail portfolio. Here it is typing mistake is there, 0.6%. I have to correct it. It is 0.2%. Single loan should not exceed 0.2% of the total regulatory retail portfolio and single loan not to exceed 7.5 crores. Single loan to a borrower. All these loans will come under regulatory retail. So up to 7.5 crores, you need not consider your ratings, etc. for your risk calculation and capital calculation purpose. Simply you apply 75%. Educational loan, you have given 1 crore. Or small, your small value model or manual model up to 2 crore rupees, you have done risk rating and given loan up to 2 crores. 2 crores, you need not, for calculation of capital, you need not check your small manual model. Straight away, you apply 7.5 crores to 75%, usko 75% risk weight you multiply. This is what regulatory retail ka effect, right? Any HL of 10 crores will not come under regulatory retail. Threshold limit it is exceeding, it will not be regulatory retail. We have to take it again basing on risk rating. Because threshold limit 7.5 crores it is given. If it is exceeding 7.5 crores means it is not regulatory retail. Right. Next. Capital conservation buffer. I told you we have to maintain apart from 9% our tier 1 and tier 2 capital, CCB is to be maintained at the rate of 2.5%. 2.5%. What is the CCB? Banks to build up capital buffers during normal times, that is outside period of stress, which can be drawn down if losses are incurred during stress period. You save and it will be useful for bad days. That is simple. That is what CCB ka example, capital conservation buffer. And next one, counter cyclical capital buffer. This also I told you, same. So during the periods of stress, it will be helpful to achieve broader goal of banking sector forms some period excess aggregate credit growth. Whenever your position is good, you maintain some 0 to 2.5% of CCCB. It will take care when excess aggregate credit growth is there. This is what CCCB, counter cyclical capital buffer, but at present it is not introduced anywhere. It will be introduced in future. Next one. 3 ratios it is given in Basel 3, leverage ratio and net stable funding ratio, liquidity coverage ratio. This liquidity coverage ratio they have touched last time. What is this liquidity coverage ratio? Liquidity coverage ratio means next 30 days may what are all your expected cash outflows, banker. That means how many deposits are maturing, how many loans we are supposed to give, and how many bonds are maturing. All these we will take in next 30 days. What is your outflow? To meet this outflow, cash outflow, whether you are having high quality liquid assets. High quality liquid assets. High quality liquid asset means your government bonds, etc., etc. Overnight it can be encashed. Same, immediately it can be ensured. So such liquid assets you are having or not, that you have to check. So what this liquidity coverage ratio says is, next calendar 30 days may whatever your outflows are there, to meet 100% of outflows are to be met by your high quality liquid assets. So you maintain high quality liquid assets to take care of your 30 days out cash outflows. That is what LCR 100% is nothing but whatever outflows are there for next 30 days, to meet that 100% of 30 days outflow, you should maintain liquid assets, high quality liquid, HQLA. This is what liquidity coverage ratio. Next one, net stable funding ratio. Here liquidity coverage ratio, we have seen what is 30 days outgo. Similar to that, 1 year outgo, what is there to take care of your 1 year outgoes, you maintain sufficient funding. This is what to mitigate future funding risk over a time horizon of 1 year. Ratio is available amount of stable funding divided by required amount of stable funding. Similar to this LCR. LCR is for 30 days and NSF is for 1 year. Bus. Last one is leverage coverage ratio. What is this leverage coverage ratio? It is a capital measure divided by their exposure method. So how much tier 1 capital you are having, how much tier 1 capital you are having in relation to your total assets, not risk weighted assets. This is what, that is what total exposure. So tier 1 capital divided by total exposures. How much tier 1 capital you are maintaining in relation to your total exposure. Earlier in capital calculation, what we told, tier 1 capital plus tier 2 capital divided by risk weighted assets. Example also I told you, suppose our assets or loans or portfolio is 9 lakh crores and risk weighted assets may be 4 lakh crores, because you are multiplying with risk weight given by RBI and external agencies, etc. So risk weighted assets 4 crores, whereas actual assets is 9 crores or 9 lakh crores. So here for leverage ratio, you have to take 9 lakh crores, not your 4 lakh crores total. And tier 1 capital only you take. That is why here leverage ratio should be 4% for domestically systematic important banks and 3.5% for other banks. Since our bank is not DSIB, we have to maintain 3.5%, whereas our capital is more than 14% and leverage ratio, they says you maintain 3.5. Since capital itself is more, it will be more than 7 or 8% here, our bank. This is about leverage ratio. So up to this Basel, we will conclude and we will go for, total exposure means all loans and bonds issued by the bank. Yes, sir. Without any multiplying with risk factor, we have to take gross. Yes. How banks came to know about cash flows? That is another one. Cash flows, banks, and ALM is there. Asset liability management. At head office level, ALCO committee is there. They will be calculating all, what are all expected inflows and what are all expected outflows. Basing on buckets are there, inflow buckets, outflow buckets. I think 8 to 12 buckets are there. Basing on that, they will calculate. We need not worry about their calculations because it's head office problem. Okay. Yes. These ratios are to be calculated at head office, particularly quarterly, they will calculate. Not like our priority sector. They will calculate at the time of balance sheet, quarterly balance sheet. At the time they will calculate, right? And next one, we go for another 25 minutes. What I will do is Reserve Bank notifications I have called for, brought, that we will discuss anyway. This, what is this? Balance sheet, I think it may take 1 hour. And moreover, last session. Otherwise, I may also take after some time also, because evening times we will discuss and we will do that. Next one. If any breach in ratios, what are the implications? At present, sir, no punishments are this one. Only Reserve Bank says at present it is not given. You have to maintain this because we have not fully migrated to all. Of course, Basel III is already fully migrated. These ratios still, it is time is there. Ratios. They say 100% you maintain at present. Right. And some leverages also they are giving. Recently, because of COVID, what they say is some SLR bonds also included for this high quality liquid assets. Okay, that also we will discuss why and that deep it will go. Next one, important priority sector, important circulars, credit RBI, yeah. So generally, whatever RBI changes are coming, bank will come with circulars. Already you might have gone through circulars, bank. Yeah, all these notes, whatever I have prepared, everything will be circulated. Everything, sir. Since all the RBI notifications have already appeared in our circulars, so sometimes if any missings are there, it is better to go through, because in any IBPS exam, generally IBPS people will compulsorily concentrate on entire year's RBI notifications. Mostly they will take a good number of questions from current year notifications. That is why a little importance we have given. We will also go through this RBI notifications, and the entire 2022 notification changes I have taken from all entire year RBI notifications. This is available in just about how many pages? Maybe some 12-13 pages. It will be circulated, no problem. Anyway, important points within this half an hour we will discuss. Right, sir. Next, first regarding December notifications, whatever are there, we will see. Reserve Bank has announced 35 basis points hike in repo rate. Repo rate has now it is 6.25% repo rate. Anyway, liquidity adjustment facility for overnight adjustments, this facility has come. Is here repo rate. Repo rate means banks borrow money from RBI to meet short-term needs. This is what repo. That means Reserve Bank is giving funds to Reserve banks at repo rate. Banks are borrowing at repo rate for overnight. This is repo rate 6.25%. And here with the agreement to repurchase, again that option is there. We will discuss that also next. It will come. Under repo rate, RBI inject funds into the organization, that is scheduled commercial banks and primary dealers. The policy repo rate now it is 6.25% from 7/12/2022. Next, standing deposit facility, SDF. Standing deposit facility means if banks are having surplus funds, these funds will be parked with the Reserve Bank of India in the form of standing deposit facility. It may be for overnight or RBI may extend. Here what advantage is, banks will get 6% rate of interest. What is the 6%? 0.25% lesser than your repo rate. Bank is giving us at 6.25 rate. Whereas if you are giving to bank a little margin is there, 6% they are taking, Reserve Bank of India. So here condition is there is no security, no bonds Reserve Bank will issue. Simply they will take without any security. That is why they are giving it 6%. Suppose if bonds are involved, if you are taking security, then reverse repo, Reserve Bank will give only 3.35% only under reverse repo. So under SDF, Reserve Bank will give us 6%, under reverse repo only 3.35%. Plus, next, marginal standing facility. This is also borrowing from Reserve Bank of India. What is that? Up to 2% of our NDTL, we can borrow from Reserve Bank of India. This is also overnight or for a little longer period also. The interest rate is 25 basis points above repo rate. So now repo is 6.25, 25 basis points is above means 6.50% MSF charges. So the condition you are telling here 6.50, repo is also there. Repo may we are telling 6.25%. Repo is also giving loan to banks. MSF is also giving loan to banks. Then why this different 0.25 means under repo we are pledging government bonds. Under repo we are pledging government bonds. Some margin is there, 5% or something, whatever it is. Whereas under marginal standing facility, here also we are pledging bonds, but these bonds are SLR bonds, whereas repo may non-SLR bonds. SLR bonds you are pledging means to the extent of bonds pledged with Reserve Bank of India, to that period, Reserve Bank will reduce our SLR from 18%. So here you are pledging 2% because it is maximum permissible 2% only. So 2% of SLR bonds you have pledged here. Then for these days, your SLR will be considered at 16%, not 18%. Since the Reserve Bank is giving that leverage, 0.25% extra Reserve Bank is taking from us. This is what marginal standing facility. Bank rates. This is also taking loan from banks. But here what Reserve Bank is giving funds only to us, bank rate. It is borrowing from Reserve Bank. But here bills rediscounting we call. Bills rediscounting, nothing but just like refinance we call, just like. This is what bank rate. At bank rate only, bills Reserve Bank will rediscount and give 6.5% they charge. It is also 0.25 basis points above repo rate. So MSF and bank rate always both will be same. MSF and bank rate, right? Next, CRR 4.5%, SLR 18%. We need not worry. Monetary policy, open market. Now, this is another one. SLR holdings in held to maturity category. So only at a higher level they are asking HTM category bonds. SLR holdings in held to maturity category. Reserve Bank has increased the HTM category from 19.5 original level. HTM normally they should maintain 19.5%. But due to COVID, what they say is up to 23% you may go, up to 23% of NDTL. You may go for this SLR non-HTM category bonds. This 23%, whatever you are exceeding beyond 19.5%, this again you have to bring back from quarter ending June 30, 2024. That 19 again you have to bring back to 19.5, 23 to 22, 22 to 21, then 20, and the last 19.5%. So this is one. Second one, digital currency. This is what digital rupee. Recently it has come by now. Just it is in the form of digital token, number one. And denominations are similar to our paper currency and coins. This is another one. Distributed through intermediaries, that is banks. User will be able to transact with e-rupee retail through a digital wallet offered by the participating banks and stored on mobile phones. The e-rupee retail would offer features of physical cash just like trust, safety and settlement. It will take care. Total digital currency can be exchanged for cash equivalent to paper notes. Customers does not need a bank account to transact using e-rupees. So these are brief guidelines regarding e-rupee retail, that is pilot project. Now in another important one, CGT-MSA has decided to align trading activity, MSME retail trade and wholesale trade, with other activities of CGS1 and with effect from 1/12/2022. That means earlier for retail trade, maximum coverage was 100 lakhs only. Now guarantee coverage enhanced to 200 lakhs. This is under CGT-MSA for retail trade and wholesale trade, right? And annual guarantee fee also, earlier 2% was there. Now on par with other activities. That is also reduced. And next one in CGT-MSA, this is Agnivirs. Agnivirs, they are recruited by that, what is that, defense people, and 4 years they will work. After 4 years, they will come back. If they are not getting employment, they can start any venture. If they start any venture, CGT-MSA is covering their loans. So for them also introduce the following benefits. What is that? Extent of guarantee coverage and annual guarantee fee will be at par with women entrepreneurs, micro entrepreneurs, and units covered in North Asian region. So these some benefits are there for these people, like extra coverage, that is 85% coverage recently it has come, that we will discuss. And also your AGF also discount they are giving, that benefits they have given. So annual guarantee fee and coverage at par with the women, micro entrepreneurs and any region. Now, what are all the modifications of CGT-MSA? We will see. This is from date I told you, 7th December, 1st December 2022. Last month only. So CGT-MSA has revised the extent of guarantee coverage. The extent of guarantee coverage has been increased to 85% for zero defect, zero effect certified MSCs. So 3 types of certificates, gold, bronze and silver are there. If they are getting that certificate, it is just like ISI we have discussed, I think. So if they are getting that certification, JDD certificate, they are eligible for coverage up to 85%. And units in aspirational districts where finance is to be increased, the government has identified aspirational districts. There also it is 85% coverage. Women and SC/ST entrepreneurs, there also 85% coverage. Earlier 75 and 80 was there. Now 85% for women and SC/ST entrepreneurs. The revised guidelines for extent of coverage will be applicable to all guarantees approved on or after 1st December, applicable for guarantees approved on or after 1st December. However, it shall not be applicable in case of enhancement of existing working capital accounts already covered. So working capital already covered, enhancement code they will not cover. Next, revised extension of guarantee coverage. Now what is the guarantee? From 1st December onwards, micro enterprises, it is 85% up to 5, there is no change. Above 5 lakhs, 75%. These are also no change. Whereas MSCs in Northeastern region and Sikkim here, up to 50 lakhs, 80%, and above 50 lakhs, it is 75% coverage. Next, all common women, MSCs in aspirational districts, JDD certified MSCs, SC/ST entrepreneurs. Now Agniveer is also added. All 5 categories, coverage is uniformly 85% coverage. Now all other categories 75%. So 5 categories, they have enhanced to 85%. One is women entrepreneurs, aspirational districts, JDD certified, SC/ST entrepreneurs, and Agniveers. Right? Next, annual guarantee fee also reduced. Now slab basis 0 to 1 lakh hai to 0.75 rate annual guarantee fee, and also initial one, both guarantee fee and annual guarantee fee. 10 to 50 lakhs ko 1.10, 50 lakhs 200, it is 1.20. Again, in the standard rates, there is a discount. 10% discount is there. Who are eligible for discount? Next, women entrepreneurs, SC/ST borrowers, 10% discount. Northeastern region, including Sikkim, and there up to 50 lakhs would be given 10% discount. MSCs in aspirational districts, 10% discount in fees. JDD certifications also 10% discount on standard rates. So then rates they have given. Now Agniveers also, it will fall under 10% discount. However, if anybody is coming under all sectors, here don't give 40%. The maximum discount is restricted to 30% only. Right? And apart from this, basing on the, risk premium is also varying here. Risk premium, AGF with risk premium. So basing on your claim ratio, 15% to 70% risk premium is there. That rates also it is given. Right? Depending on degree of risk, analyze it to okay, 10% discount. High risk associated up to premium up to 70% on standard rates. Right? Revised applicable from December 1st onwards. Next, modification in ECLGS scheme with enhanced credit support to airline companies. Airline companies are enhanced credit linked guarantee scheme. So earlier what they told is ECLGS up to 4 it has come. In 5th one they told airline companies maximum ceiling up to 500 crores they have given, and subsequently it is now enhanced to 1500 crores per borrower, airline companies. Up to 100% of their total credit outstanding. Earlier, first they gave 20%. In second one, they gave 30%. Third one, they gave 40%. And next one, they went up to 50% for these cases. Now they say up to 100% of their outstanding borrowings with maximum 1500 crores you can finance under ECLGS scheme. So here, this is latest change from 6th October, 1500 crores for airline companies and 100% of outstanding as on cutoff date. Next, Udyam registration number is mandatory from January 16th. After January 16th, URN is mandatory. CGTMSE. Okay, this is regarding life certificate of super senior citizens. 1st October onward, they can submit instead of 1st November onwards. Small change. Agency commission, no change, but it has appeared in RBI policies recently. Just I have put here. Physical receipts 40 rupees per transaction. Agency commission by banks may. E-mode receipts also 9 rupees per transaction. Pension payments per transaction 75 rupees. And payments other than pension per 100 rupee turnover 6.5 paise with maximum 100 rupees. Next, modified interest subvention scheme for short-term loans for agriculture and allied activities and availed through Kisan credit card. Now, what is this changed one? Earlier, interest subvention was 2% and prompt submission, prompt repayment to go 3%. Now, interest subvention has reduced to 1.5% and prompt repayment is retained at 3% continuously. So from 2%, interest subvention on crop loans is reduced to 1.5% from this year onwards. This year and next year, same rates. Up to 2024, they have given. So coverage, it is old one only. Up to 3 lakh rupees, it is covered. In case of allied activities, animal husbandry, etc., up to 2 lakhs only, it is covered. And 1.5% is interest subvention. Calculated for 1 year from the due date, from the date of disbursement, maximum period up to 1 year or repayment period, whichever is earlier. Lending rate 7% to the borrower. Interest subvention is 1.5%. And additional interest subvention 3%. It is old norm only, no change. Here also period up to 1 year. If they pay regular promptly within 1 year, they will get 3% additional premium. Ultimately, farmers for short-term loans up to 3 lakh rupees, they will get at 4%. This is regarding interest subvention. And the next one, continuation of the same. Earlier also it is there. Suppose there, if they are keeping their produce in warehouses accredited by Warehousing Development and Regulatory Authority, there for another 6 months, this is post-harvest coverage. Up to 6 months, it will be covered, this interest subvention. In case of natural calamities, another 1 year extra coverage is there. And in case of severe natural calamities, it is first 3 years or entire period coverage is there. Up to 5 years maximum coverage. So further, all such cases, benefit of prompt repayment incentive 3% to affected farmers. So affected. That means restructured loans also eligible for interest subvention. Unhedged foreign currency. This already we have discussed earlier. Now in case borrowers earlier 25 crores was there. Now it is enhanced to 50 crores. In our policy, 25 crores we have mentioned, but recently it is enhanced to 50 crores. That means if borrowers with exposure up to 50 crores, if they do not provide unhedged foreign currency details, bank shall apply incremental provisioning of 10 basis points. That means if it is a regulatory retail 0.7, the 75% and provisioning normally 0.4% we will keep for small loans. But here 10 basis point means 0.1%. So instead of 0.4%, 0.5% it will come provisioning. This is what standard assets incremental provisioning. In case of non-submission of unhedged foreign currency details, right? Next, e-invoice. GST e-invoicing is mandatory for terms with a turnover of over 5 crores. Earlier it was 20 crores, now it has brought down to 5 crores. E-invoice is compulsory GST ka 1/1/2023. This is one. ARCs, asset reconstruction companies. What these companies will do? They purchase NPA from us and they recover because legal experts, etc. recovery mechanism is there. They will purchase NPS from banks and they recover. So for that, for them guidelines, their net owned funds increased from 100 crores to 300 crores. That is one. Second one, ARCs to achieve this by 2026. They have given time also. If ARCs are allowed to act as resolution applicant under IBC, Insolvency and Bankruptcy Code, they can act as resolution applicant also. Instead of appointing some outside agencies, IBC may appoint these asset reconstruction companies also, since they are eligible. So such ARC should have at least net owned funds of 1,000 crores. So now normal ARC 300 crores. If they want to participate in IBC as resolution agent, then their net own funds should be 1000 crores. Latest change. And minimum CRAR 15% they have to maintain. That is common. And another one, securitized receipts at a minimum of either 15% of transfers investment in SRs or 2.5% of the total SRs issued, whichever is higher. Here the condition here is ARCs, what they will do. Suppose if they are buying NPA from us, say 100 crores ka NPA, we sold them for 50 crores. So they took it for 50 crores. What is the bank condition? 15% they have to give us upfront. So 50 crores may 15%. 7.5 crores immediately they have given us funds. Remaining 42.5 crores they have to give away now. They will issue securitized receipts. 1 crore each, like that they will issue. So 48 certificates they have issued for 47.5 crores. In that security receipts again, we may also purchase those security receipts. So now, how much these SRs has to invest in that? Total is may 2.5%. Security issues total kitna? 47.5. समझ लीजिए 48. 48 में 2.5%. और our investment may be उसमें 10 crores. 10 crores में 15%. That means 1.5 crores. Whichever is higher, they have to invest. That means their stake also should be there in each purchased asset. This is indirectly, right? This is about ARC. Daksh, of course, it is a portal, web portal of Reserve Bank of India to monitor corporate NBFCs. This is regarding corporates and NBFCs, I told you. Normally, external credit assessment institutions, that means our risk rating agencies, risk rating agencies, they will do risk rating of the borrower, corporate borrower. After doing risk rating, they will keep this risk rating in their website or they will release it to press release with the consent of this borrower. It is common practice. In such cases, while keeping in their website or press release, they have to mention our bank's name, that financing bank's name and exposure also. If they are not mentioning bank's name and exposure, suppose Canara Bank has financed, and apart from 2-3 banks have financed, they have mentioned other bank names, Canara Bank name not mentioned. In such case, what this is, Canara Bank should not take it as a rated one, externally rated one. Don't consider it as rated one. So you apply unrated risk weight because bank's name with exposure is not mentioned. This is what additional guideline, right? 150% you can put. Credit guarantee for startups. So for startups also, NCGDC has started one credit guarantee. Isme annual guarantee fees is 2%, 1.5% for Northeastern and women entrepreneurs. That is another one. Risk premium here also it is there. 10% NPA level, if it is 10%, 0.25 risk premium. If NPA is more than 15%, 0.5% premium extra. NPA level 20% exceeding, that means 0.75% extra premium. Right. Here also umbrella based guarantee covering a pool. Such loans 0.15% of annual charges. So here both are there. Small loans saito umbrella coverage or individual loans saito separate 80% for loans up to 3 crores and 75% for loans above 3 crores up to 5 crores. This is coverage. 65% for above 5 crores. Lock-in period is 18 months, just like CGT MSC. Here also. So coverage it varies here. And small loans again umbrella coverage, just like our retail portfolio, they will cover, right? ECBs, external commercial borrowings through automatic route. Earlier, banks borrowers are permitted to raise up to $750 million through this automatic route. Now it is enhanced to 1.5 billion. That means doubled. $1,500 million or $1.5 billion. They can raise under automatic route. And all-in cost ceiling also they have enhanced by 100 BPS. From 500 BPS, they have enhanced it to 600. That means they have raised that benchmark rate plus 600 basis points. This is overall cost, all-in cost ceiling. Windfall tax, it is another nomenclature they have given. Windfall tax means without that corporates intervention or efforts, some profits are coming. Just like recently oil prices, barrel prices have come down drastically internationally. Then oil companies have got profit, good profits. So what central government has done, since you have got some profit, that profit is called as windfall profit. Windfall profit. Since these companies have got windfall profits, government has levied tax that is called windfall tax. As a one-time measure, they tax on oil companies for their profits, which came without their efforts. That is what windfall tax. So now credit information companies also, they came under integrated ombudsman scheme. Earlier only 3 are there, now another one, fourth one also added, covers commercial banks, cooperative banks, NBFCs, and now this CICs, credit information companies. Interest on FCNR and on NRE. FCNR be deposit same rate only, but I will tell you why it has come. If FCNR period is 1 to 3 years, alternate overnight alternative reference rate plus 250 basis points. If period of deposit is 3 to 5 years, ARR plus 350 basis points. That means 3.5%. ARR plus 3.5%. Because several times they are asking this question. Again, I have put here. And recently what Reserve Bank has told, up to 31st October, banks can raise these rates and collect deposits. So whenever there is requirement for foreign currency inflow, Reserve Bank will tell you, the Reserve Bank will give free hand to banks. You may increase the rate of interest on FCNR and NRE and get some foreign funds. Those funds, whatever you are getting, that is incremental deposits, they are exempted from SLR and CRR. And loans against those deposits are exempted from calculation of ANBC for calculating priority sector advances. So these are the guidelines regarding incremental deposits of NRE and FCNR. That is why I have given important for exam purpose 350 and 250 basis points, right? Now, international trade settlements, they can do through rupee Vastro accounts specially opened by foreign banks with us. Rupee Vastro, normal Vastro accounts which are there already with us. Now, exclusively for international settlements, they can open rupee Vastro accounts with us. This is another guideline. And they can make payments either for imports or exports through this account they can operate. This is what rupee Vastro account is. Credit cards, one recent guideline, it is what they say is credit card name. Banks are just like that sending credit card to customers, whether they are requesting or not. In such cases, the customer has to activate that card within 30 days normally. If customer is not activating, bank may send them message to activate the card within 30 days. If within 30 days, if customer is not activating, so immediately within 7 working days from the date of seeking confirmation from the customer, card is to be closed. Customer says, I don't want. So within 7 days, you have to close. Or there is no response from the party within 30 days. You have to close without any charges. This is regarding credit card. Failure on the part of card issuer to complete the process of closure within 7 working days, it shall result in a penalty of rupees 500 per day of delay payable to the customer. Credit card issuers, this is penalty, provided there are no outstanding amount of the card. Okay, if credit card is not used for 1 year, just intimate and close. Thus, PM Swanidhi, up to 50,000 rupees, third loan has come with repayment of 36 months. Only thing is, first loan is to be, the second loan is to be closed. That is minimum repayment period. Here, minimum repayment period for second loan is kept at 6 months to be eligible for next cycle. Otherwise, what parties will do? Today they will take second loan and after 1 month again they will close and come for 50,000. That is why this is minimum repayment period for second loan is kept at 6 months. Suppose if they close early also, they have to wait for 6 months. That is the condition. This interest comes subsidy is same. We need not worry. Annual premium, this already our circular also came. Pradhan Mantri Jeevan Jyoti Bima Yojana, 330 to 430 rupees premium is enhanced. Pradhan Mantri Suraksha Bima Yojana, it is 12 rupees to 20 rupees enhanced. Very important for current exam because recently, this year only it is enhanced. Compulsorily those people will touch. Out of that administration, our cost is 17 rupees for out of 436 and 1 rupee 50 paisa out of 20 rupees. Thus, quoting of PAN or Aadhaar number is compulsory for cash depositing or withdrawing over 20 lakhs in a financial year. This is another one. Gold card scheme, same. There is no change, only the repetition. Consumer redressal forum also, it has come changed. I think already it is covered by SAR. That is why I have seen. Consumer redressal. Legal entity identifier, we have discussed this periodicity. This also a little important. Agriculture Infrastructure Fund. It is National Agriculture Infra Financing Facility. This is for here cold storage and controlled atmosphere storages, credit linked back-end subsidy of 35% for project in general areas and 50% for project in case of northeastern and hilly areas and scheduled areas. Right? Gold monetization, no change as it is. Sovereign bond also no change as it is. Because it has come, just I have put national payment system. National pension system, the age is increased to 70 years. This is latest change and important for current year. Exit norms. Pre and post shipment, of course, this is for telecom sector. Innovation hub, right? Digital payments. NABARD, this also it has come in MSME. Be aware. Microfinance loans. Microfinance loans, morning I have already discussed this. Microfinance loan is defined as a collateral free loan given to household having annual household income up to 3 lakhs. This is irrespective of area. Earlier rural separate, urban separate, yeah, now it is common 3 lakhs. Next, repayment obligations towards all existing as well as proposed loan installment. They shall be subject to a limit of maximum 50% of the monthly household income. So whatever their earnings are there, repayment should not exceed 50% of their monthly earnings. This is what condition. DSIPs, I told you, domestically, systematically important banks, 3 banks, SBI, ICICI and HDFC. That is another one. NBFC factors, net owned funds 5 crores minimum and 50%. Morning I discussed this 50% class. CGTMSC hybrid or partial, it is only clarification. Hybrid model mein there is no ceiling for credit. Whatever may be the loan amount, we can take partial security, collateral security, and CGTMSC will cover up to 2 crores per borrower. Next, National Asset Reconstruction Company Limited. This is nothing but bad bank, other name. It is a government bank registered assets. Resolution process will be managed by Indian Debt Resolution Company, bad bank. PCR 70%, already we have discussed this. ECBs already we have discussed this also. LEI, sir, this is another important point. Legal entity identifier, 20-digit number. What is now important is undertaking any current account or capital account transaction of rupees 50 crores and above for transaction under FMA. They have to mention 20-digit legal entity identifier. Earlier, we are telling about only borrowings only we are talking. Now, remittances also, current account or capital account transactions under FEMA, 50 crores and above transactions, compulsorily, they have to mention legal entity identifier code. This is regarding LEI code. This is 13 pages RBI ka changes. This also I will share with participants. Okay. Now, any doubts, if any, there, I am ready to clarify. If no doubts are there, we will wind up the session. Any doubts, you are most welcome. Yeah. Thank you. So I will tell.
Thank you, sir.
Yes, sir. Thank you, sir. Thank you. So we will wind up the session, sir.
For sharing your time and
it is my duty. CBI, my duty.
so
Because CBI is my
you have been
organization.
handling nearly
Yes.
for 7 hours.
Yeah. Thank you, sir. Thank you very much.
Thank
I'm very much thankful to CBI for this opportunity.
Thank you, sir.
Thank you, sir. Thank you. Okay, sir. We'll wind up.
Friends, you are asking about the materials. Whatever
Yeah,
materials,
Naveen will share, sir.
we will share it.
Yeah.
Some
Naveen
of the
sir.
materials already been shared. Other things, I will get it and share it.
Yeah, immediately I'm sending you, sir. You may share. Yeah.
All the materials will be made available in CBOA site.
Yes, sir. That also will do, sir. Yeah.
There is an
Yeah.
online test from 5 o'clock. So whoever wants to take up the test, you can log out and join the online test. Balance sheet session, some of the people are asking. We will try to accommodate in.
Yeah, sir. Next evening sessions, if I can also deal. But after completion of this classes, I think by Tuesday this class will be over. I can deal even tomorrow. Ravi is coming. We'll try to discuss tomorrow or day after tomorrow. We'll finish it up, sir.
Actually, day after tomorrow, Ravi Kumar's slot is there, sir.
So in that case, I will also ask Ravi at least to cover. Otherwise, even I can also spare basing after completion of this sessions here, Hyderabad. Mein.
Okay.
Yes, sir. Yes, sir. Yes, sir. Thank you, sir. Thank you.
Thank you, sir.
Thank you. Yeah.
Those who want to join online test can join through this link. Mr. Navaniswaran, you are not in any group. Huh? Online test, they have even shared the menu, all the instructions they have shared. You can even attend the other previous test also. So you get to the, from your local people, you get the, that whatever online test instruction they have shared. If you get that, you can easily attend even previous test. Test today 5 to 6:30, sir. You can join now. Previous test also available, madam. In that link, if you go, you can see. Okay, all the best to you. Thank you.